thing. I was really impressed by the Framingham study. That's the largest study ever done
That
on the American
dragon's roar just
population
shook
health
my
study.
bones.
And it says the
What's your
number
plan to
one
take it down this
predictor of
time?
how long
Any
you will
clever
live
tricks up your
is
sleeve?
lung function.
Mm-hmm.
So the more powerful your lungs are, and you can do that through screaming, I guess, if you're a day trader, or short-term high intensity, that seems to be the best way, called hits, or
Mm-hmm.
some call it pack 8 or something like that,
Yeah.
pace 8. A real intense short-term blasts of exercise will help your lung function. Obviously, you don't want to smoke anything. You don't want to do anything that's going to be bad for your lungs. That's the number one predictor of how healthy you're going to be. So anything, I used to think when I worked out, when I played football, lift weights, I thought that was all to make me healthy. But it's really the lung function that's going to make you the healthiest. So that's the number one thing. Obviously, watching your diet, not getting overweight. So then switching into the markets, just know you're going to get beat up in this business. This is not an easy business. Despite I read all the instant paths to wealth on the internet, and God damn, that looks really easy. I wonder if I could do that. I go, wait a minute, this is trading. This is what I do. Be really careful. Ronald Reagan said it best: trust but verify. You read all these internet claims, may look into them, but don't buy it until you verified it. This is a big up and down business, and you better be emotionally prepared. And more importantly, if this isn't for you, the sooner you get out of it, the better it'll be for you. Not everybody's cut out to be a trader. Once you acknowledge that, you leave this behind, you're going to have a good, clean life again. So that's really important. It's like, you know what, this isn't cut out for me. Get out of it. And if it is cut out for you, don't look for instant wealth. This is the ongoing educational experience. I've known traders who are still trading older than I am. And that was pretty much what they said too. There's an old soybean trader. The trading was 86 years old. And he said, I'm still learning this. He was a pit trader. He said, I'm still learning this. And so am I. And that's a kind of a nice thing that every day there's something to learn. This is, it keeps you awake, keeps you alive.
And you're always still going to make mistakes that you got to work through. And yeah.
Oh, yeah. And mistakes. When I used to do live things, I'd ask a show of hands, how many people here have lost money, not because of your market calls or judgment, but because of your trading platform? You didn't use it right, or you didn't understand it, but the trading platform lost. But all the hands go up in the room. So the trading platforms are dangerous. I'll bet you've made mistakes with a trading platform, right?
Yep, for sure.
We all have. So you better really know your trading platform and double check and triple check your orders. You click, oh, it's too easy to do it. I distinctly recall in the old days, I had a broker, Ed Walter. I called him up one time and said, sell 30 soybeans to the market. He said, you mean buy, don't you? I said, yeah, I said buy. He said sell. He knew that I wanted to buy, right?
Yeah.
But it was an error. He caught it. There's nothing to catch your errors now, except you. On these trading platforms, you can be very, very careful of them.
Perfect. And just one last question, Larry. What do you think has been the biggest changes to the market over the course of your career? Has it gotten a lot faster? Yeah. What kind of is different nowadays?
Well, the big difference for me in commodities is going to electronic markets.
Yeah.
And we don't have those pit sessions anymore. Starting about 2002, we went into electronic markets. So we open, we close. And part of that is, as we talked about earlier, thanks to the internet and electronics, the marvels of today, everybody knows instantly the news in the marketplace, the news around the world. So the markets are much quicker, but time frames that worked in the past are not the time frames that work today, which tells me again, I have to adapt to the markets. The markets don't care about Larry Williams. I have to care about them. I have to adapt. There'll be other changes. We talked earlier, my big trading markets were pork bellies and soybeans, and all those things hardly exist anymore, right? I'm now trading things that didn't exist when I first started trading. Gold was illegal to own when I was a young guy. You couldn't own gold in America. It was illegal. You couldn't own it. And now I'm trading it and trading treasury bond. There were no treasury bond contracts. So I don't know what there'll be in 30 years about cryptocurrency, I guess. I don't know. But you have to stay alert and awake as to the trend changes in the world, not just the markets.
Perfect. And any less thoughts on kind of trading psychology and advice specifically about that? Because I think that's a big part of trading as well.
Well, this is not a business for perfectionists.
Yeah.
The perfectionists want to be right. You're not going to be right all the time. So it's really tough on perfectionists. You have to just realize that you're going to take your lumps in this business. And that's the best part of psychology. Really, some people say you're trading your own personality. I know this. My son's a psychiatrist educated at Johns Hopkins, and Jason did an interesting study of just winning traders. All the
Hmm.
other literature before had been on losing traders. So I introduced Jason to some major winning traders in the world, names you'd all know. And he did a personality profile of these traders. And we learned several things from their personality profile that might help. One is they're all really good with details. That's my real weakness, by the way. They all had strengths and weaknesses, but that was stood through them. Also, they were not very emotional people.
Hmm.
You could walk right up to them and say, "Hey, your wife just left you," or whatever. They probably say, "Oh, okay. Well, I have to go trade the markets now." Their emotions don't flip flop back and forth. They don't,
Right.
and I think I'm pretty good with that because I've been trading so long. But they don't get real emotional
Hmm.
about things. That's one of their strengths. Here's the interesting one we learn. They're not overly confident people. You'd think some of these people are multi-billionaires. They'd be like, hey, buy, sell, whatever. They're not that way at all.
Hmm.
I think that's probably why they're successful, because you're not really overconfident. You never bet real big.
Yeah.
So that's an interesting insight. And in reflection after Jason's survey, I can think of a lot of traders I knew who blew up, and they're all yelling, screaming, shouting, pounding their chest, look how big of a guy I am. They all blew up. So you don't want to be real confident in this business. You want to be good with details in this business. You want to don't be overly emotional in this business. Those are the traits of really winning traders. People could read Jason's book, which is The Mental Edge in Trading by
Hmm.
McGraw-Hill, if they want to learn more about that.
So you're basically saying you can't. It's tough to be a good trader when you've got a lot of ego, where you've got that overconfidence, the cockiness.
Yeah, because you'll bet too big.
Yeah, yeah. Larry, thank you so much. I think we've covered a really extensive amount of knowledge in this interview, and I want to really thank you for your time. And I wanted to ask you, where's the best place for people to reach out to you or contact you if they have any questions and want to learn about your methodology?
Please don't contact me. I'm trying to retire and I'm failing miserably at it. Um, our website is ireallytrade.com. I don't do anything anymore publicly. I will do my annual forecast report at the end of this year, which has been really, really accurate. So we know a year in advance what stocks are going to do. But short of that, you can go to our website.
Welcome to the Trailline Podcast. I'm your host, Richard Moglen.
It was a pleasure.
Perfect. Yeah, yeah. Glad to have you on. And obviously, we've done a chat previously on my channel, but it's great to have you over on the Trailline channel as well. And for those people who didn't kind of watch that, I'd love to kind of get started with hearing a little bit about your journey, your experience, obviously managing money, and yeah, kind of your evolution as a trader throughout the years.
Well, it started out just like about everybody, I'd say. I have no clue what I was doing, and started buying mutual funds when I was a paper boy at 12 years old, and that graduated up to stocks when I came out of school as a chemical engineer, by the way, back in 1974. Give a plug to my alma mater, Clarkson University. And I ended up moving to St. Louis, getting a chemical engineering job for about 8 years. And meanwhile, I was really, really working hard at trying to understand stocks. A lot of the guys around the lunch table had, exchange ideas and books they'd read and whatnot. And I kept trying to figure out how to be consistent. It seemed as
Right.
though I made some money, and I caught a beautiful bull market right out of the gate in 75, 76. So bull markets can make you feel real big about yourself, but in reality, you really don't know what you're doing. And later on in the 70s, had a few lessons taught to me. And meanwhile, I started gearing up futures trading, because one of the guys that I actually ate lunch with did dabble in futures.
Hmm.
So that kind of whetted my appetite. One thing led to another there. It took me 4 years of losing money to ever get back to break even, or to get a profitable year, basically, where I was actually producing a positive profit. The rest of the years were a loss, and then less loss, and then less loss. I knew I was making progress, and I stuck with it. Thank goodness, I guess. Once I got profitable there, I was also nicely profitable over in the stock area. We started managing money for other people, three guys together. I sold my share off and went and formed Trendstat, eventually moving that down to Scottsdale,
Hmm.
which is where I retired in 2004, basically, to shut Trendstat down in 2003 and shut down some automated trading that I was doing through 2004, and put a smile on my face. And I've been retired ever since. 18 years now, I think it is, something like that.
Perfect. And for those people who don't know, Tom, you've been featured in Market Wizards by Jack Schwager. I actually got a chance to talk with Jack, I think last week or 2 weeks ago, and got to ask him kind of what his favorite question to ask everybody he interviews is. And he said, what was the biggest loss you've taken? So I'd love to throw that at you and kind of talk about some big mistakes and big losses you've took that kind of hopefully you learned a lot of lessons from.
Yeah, the largest loss dollar wise comes to mind that when I'm managing a whole bunch of money for people. And the first Iraq war is breaking out. Just is back in H.W. Bush's time.
Hmm.
And we have a computer problem. And Dave Dukes, one of my computer guys, and I are trying to figure this thing out. And we're both looking at the code and trying to figure it out to get our orders in
Right.
so that they're there for the next morning. So it's getting to be about 5 o'clock, and I decide, hey, let's take a break. I'm going to go across the street and grab something to eat, and we'll take a break for dinner and just let our minds relax for a second. And I'm sure as heck we come back after dinner, we find it right away. So I leave it to the computer guy to go ahead and put the code together, and we'll get them run and tested, and then we'll run the orders and we ship them, and everything's fine now. So I go over the computer and I look at our screens, and crude oil, which had closed at 32, was now $40 a barrel. And I'm going, $8 a barrel on a $32 price. What the heck is going on? So I'm searching the news, and all of a sudden I realize war has broken out.
Right.
And the Air Force and the armored vehicles and stuff are just going from Kuwait right into Iraq, and they're practically being unopposed. But meanwhile, crude oil's all nervous. So we're long, and it's now at 40, and I'm thinking, oh, this might be a really nice day tomorrow. So I go to sleep, I get up just like I usually do and come in. And the first thing my head trader tells me is, man, we're going to have some phone calls today. Crude oil's at $22 a barrel.
Wow.
It had gone from 32 to 40 down to 22. We got stopped out when it opened. So we took somewhere in the neighborhood of, I want to say, between $5 to $6 million worth of losses in one day. That was a pretty eventful day dollar-wise. In terms of percentages, it would probably have to go back to some of my futures trades back when I had no clue what I was doing.
Hmm.
And I basically wiped the account out, but it was only a few $1,000s, so no big deal. And I can't remember any details. And there were probably several of them along the way when I was trying to figure this thing out. But it's somewhere, yeah, that was a very large dollar, was the crude oil trade.
For sure. And
And what I
yeah,
learned from
go ahead.
that is basically, you asked what I learned. What I learned is that you got to think in terms of percentages, because I was managing, I don't know, probably $400 or $500 million back then, and this was just, a bad day. We made new highs a couple months later. It wasn't
Yeah.
any big deal. And to stay with your approach, just keep running it and keep managing your risk. What happened on the short sell signal with that same trade, we got out of the long, and then there was a short, and we would have
Hmm.
taken the short, except when you did the math and you used all the position sizing that I talk about in my book that's available all sorts of different places. on position sizing, it would say measure your risk and measure your volatility and size your positions accordingly as a percent of your equity. Well, the risk was from 22-ish all the way back up to 40. So that was going to be a very large risk for that one trade, and the volatility had skyrocketed overnight. So if you didn't have about a $4 or $5 million account with us, you didn't even get one contract. It came out zero in the calculation because there was so much risk and volatility. No matter what kind of equity you had, you couldn't afford to do even a contract. So that did a good job of keeping most of our clients out of the short sale. And shortly thereafter, we went long again, and everything was fine and made new highs. And no big deal, but there was a lot of lessons there in discipline, following your strategy, and thinking through developing your strategy so you can handle a strange situation like that. And ours did, and it was fine.
Right. Perfect. And when you were first starting out with trend following, what were some kind of aha moments where you kind of turned the corner? Maybe it was developing your position sizing techniques, that type of thing, because I'm sure a lot of people watching this are kind of new traders, new to trend following. So I'm sure they'd be happy to have to receive any advice you could have.
Yeah, the most profound thing I've ever thought about that it was an aha moment for me was probably back in the 70s when I really truly believed in trend following. I really truly grabbed onto it and rode it for decades. And it was this, that when you say put 10 or 20 charts, whether it be bar charts, point and figure, whatever, of like 10, 20 different markets, and you spread them all over the floor, and you stand up and you look down at those charts, you can, from a distance, see exactly the trades that you would love to be on. Oh man, that hog trade over there, that would have made me a ton of money. Oh, look at that euro trade over there that went short. Oh my gosh, look how far it went. Gold doing this, silver doing that, hogs the stock market doing this, the Nikkei doing that. You could easily see from a distance those trades that you really want. Now, if you ask yourself in typical trend following math, I don't care if it's a simple moving average, exponential, point and figure breakouts, bar chart breakouts, Dungeon channels, Keltners, Bollingers, all of those, I don't care which one you use, none of them will ever miss a single one of those very large trades. They'll catch every single one of them. And that's what I wanted to be in on. And I became a trend follower. And that was a huge aha moment. I never again will ever miss a large trade that comes in any market that I trade. And I haven't since. And so you get years like last year, for instance, 2020, we're here doing this in 2021. 2020, you had the COVID crash. So you had a stock market down 30-something%. Then it turns around on a dime, and everybody's talking about the potential double bottom. We've got to test the bottom. It never came. It V-bottomed and boom, right up again. And I had the best year of my life at 103%, not really trading that aggressively, but just catching huge amounts of major market movement. Why? Because I'm a trend follower. So I got all the signals, I went with them, and made a lot of money. In other years where there aren't those types of moves, I tend to get chopped. I tend to have small losses. They might add up. I might have a losing year even. I keep trying to work on getting that more consistent, and I've made progress. But I'm still learning and adding new strategies and trying to come up with ways of smoothing it out even more. But boy, the aha moment of I'll never, ever miss another major move. But last year is just in spades was an example of that. And that's fed my profits over the years.
For sure. And
on position sizing, if you wanted to have another aha moment, it was
sure.
the position sizing. I wrote the book just recently, but when I came up with position sizing for TrendStat back in, the early 80s and mid 80s, man, that was a huge deal because all of a sudden you could smooth things out. Your drawdowns got smaller. I think position sizing is far more important than your entry and exit. You just have what you use. You got to have an entry and exit. I think you should have what I call a buy-sell engine. It's appropriate, but that's not as important as knowing how to size your positions appropriately. Because if you overcommit, you're going to be dangerous. If you undercommit, you're going to underperform.
Right.
Finding that sweet spot is tricky, and if you can get that position sizing nailed down, that's a really good thing.
And a smoother equity curve and decreasing your drawdowns, that helps your emotional capital as well.
Yeah.
Exactly.
If
Yeah.
you want to be Mr. Serenity, you should think about that.
For sure, for sure.
Yeah.
And going a little bit back to the mental side of things, back in 2020 with the COVID crash, obviously, yeah, everybody's thinking we're going to retest the bottoms, we're going to even undercut things and continue into a multi-year bear market. Could you talk a little bit about honoring your system, sticking with your buys and sells, even when your gut and everybody in the media and social media is saying, you know, we're just going to roll over. So you could you talk a little bit about trusting your system and your research and yeah, the process basically?
Yeah, I would say you have to, as a trader, this was another aha moment probably way back in the 70s. I used to read Herd on the Street in the Wall Street Journal.
Mm-hmm.
This was pre-internet. Well, pre having free internet and all the stuff we have today. So you got a piece of paper and you're reading the articles, and Herd on the Street was always an opinion of some person on a Monday morning, let's say. They'd write it over the weekend, ship it in, and they'd send these things out to everybody. And I quickly realized that as an engineer, I knew what a piece of data was. Like the Dow Jones closed at X. That's a fact. That's a piece of data. I think the market is going to have a double bottom and test the bottom. That's somebody's opinion.
Right.
And I trained my mind very young as a trader to be able to separate other people's opinions from facts. So you could have one sentence with the Dow Jones closed at, pick a number, 4,000 or whatever number, and it's likely to test that again before it sells off very much. Okay, so there's a fact in there and there's an opinion in there. And I can just cubbyhole those beautifully these days. And what I learned I needed to do was to form my own opinions, and what other people were thinking didn't make any difference at all. And when I did that, that freed me up to go seeking facts, go seeking data. And it led me down the path of being much more systematic with what I was doing, because that way I can look at data, have my algorithms, my logic, whatever I'm using for that particular trading strategy, to go against the data to make decisions. And that is really my opinion.
Mm-hmm.
That's the essence of my opinion, because however I constructed that algorithm was my opinion of a good way to trade, right?
Mm-hmm.
In all conditions, perhaps. So that's probably the kind of thing that was an aha moment there. And I think that's what a lot of young traders need to do. And I don't know if that answers your question, but that's kind of an aside from my early career.
No, that's absolutely perfect. And I also wanted to ask you, I consider myself also a trend follower. My guiding light kind of is the 21 EMA and 50 SMA, very
Sure.
classic Can Slim foundation.
Nice.
But I also am kind of discretionary because I make my decisions. I don't have basically algorithms in the computer deciding when I buy and sell. So
Right.
could you tell me a little bit about why you chose to actually go the programmed route, how you got into algorithmic trading, and yeah, the backstory behind all of that?
Yeah, I think really what it comes down to is if I were to sit there with Richard day after day after day, and every time you made a discretionary decision, I'm sitting behind you and I said, now, Richard, why'd you make that decision? Why did you take this trade? And why did you not take that trade? As you
Mm-hmm.
described to me why, you would be using certain your opinions of going after facts or data,
Right.
or a chart pattern or whatever. And I'd write that down, and I'd
Mm-hmm.
every day ask you that question over and over again. I'd keep writing stuff down. After about 3-4 weeks, I'd say, hey, Richard, let's talk. And what I'd what I would probably find is that, there's some consistency with the way that you make your discretionary decisions. If you see this type of action, you lean a little more likely, and you may not even be consciously aware that you're doing that, but you might repeat yourself more than you think. And once you figure out and you're aware of what you're doing, you find you can build that right into your system, and then you don't have to make that decision anymore. It's being made for you. So I think even guys like Paul Tudor Jones, I think somewhere along the way I heard back when Peter was with him, I think they tried to take Paul, who is supposedly a renowned discretionary trader, and try to algorithmize what he does.
Right.
And I don't know how successful they were with it, but that was a goal because they realized that he does certain things over and over again. And what can we do to take that thing that he does and turn it into, computer code? And I think there's something to that. I don't think you're just making it up every day as you come in. So once I realized that, I said, why am I wasting my time doing discretionary trading at all? Why don't I just have the computers do all of it, and I'll go play golf?
Right.
It freed me up to be a businessman that runs a trading business as opposed to a trader that sits there in front of a quote machine all day trying to make discretionary decisions and hopefully be brilliant about it. I kind of put myself out of work.
Makes sense.
So I looked at it.
Yeah, it goes into your work-life balance. It frees up a lot of time for the things you actually enjoy, especially being retired, of course.
Sure does, especially being retired. I have it down to where I do everything. 8 strategies, and I think I counted like 52 positions today that I own across, 25 futures markets and some, 23 ETFs and a couple of odds and ends and things like some options and a couple of other stocks that I own from the old days. 50 plus positions, 8 strategies, and I ran them all today, and I got it all done in about 23 minutes or something.
Yeah, that sounds like the life, honestly, for sure.
It's not that burdensome. Yeah. I mean, I also did my Spanish lesson. I also looked at my emails. I checked out social media. I mean, I probably was at my computer less than an hour. Got everything done.
Right. And you mentioned Paul Tudor Jones. Were there any traders as you're kind of studying this and developing your own style who you really looked up to and tried to look into what they did and emulate them, basically?
Well, I'll tell you 2 different stories there. One early, and one a little bit after I'd become a money manager. The early, you got to picture this. I'm an old guy, okay? You weren't born when this was happening. I looked around and, it's Wall Street Journal times. I don't even know anybody that's trading futures that's a money manager. I've never even heard of anybody. I did go see Jim Stowers, who was a stock manager over in Kansas City when I lived in St. Louis. We went over and sat with him and got some ideas on how he managed his mutual fund. But other than that, and there was maybe a couple people in St. Louis that I tried to go and ask questions and learn from. But basically, I realized early on that I could kind of make a description for myself of what would be a perfect trader. This imaginary super trader that is cool and collected and does everything right and sizes positions perfectly and always follows a strategy and always puts a stop loss in and diversifies his portfolio and all these, magical things that everybody always talks about. You could write down, a lot of people listening to this podcast probably could write down those characteristics and say, that would be super trader.
Right.
So I did that. And in my mind, in my early going, I always compared myself to super trader, which was this imaginary perfect trader. And I'm trying to be more like him. So I kept gravitating and trying to, be more disciplined, be more aware when I was deviating from my strategy, watch my risk, size my positions, all this stuff. And it helped me a lot, just kind of climb up the ladder and try to push towards perfection. I haven't gotten there yet. I never will. Nobody will. But you can always create that perfection in your mind, it's like the perfect round of golf. What does it look like? Well, I've never shot it. I know for sure I've never shot it. I probably haven't even come close, but I know what it looks like.
Right.
And so every time I go out there, I try to get a little closer to it. This is kind of the same concept. Later on, as I actually started managing money, and we had I actually was managing, my own account, and my accounts were starting to get up a little bit in size. I had probably a $100,000-$200,000 stock account. I had a $130,000 futures account. So things were getting better. I was starting to make some decent money. Trendstead had gotten off the ground and all that. So along comes I guess the famous Silver Trade and New Market Wizards, the book that Jack wrote with my chapter in it. And there, I always liked Larry Height reading Market Wizards. He was in the first book, I was in the second. But round about that same time, after that silver trade, where silver went, took my account from 130,000 up to 500,000 and back down to 250,000, I realized that something had to change. I was position sizing had a flaw in it. And I had risk sizing, but I came from a very low risk trade. So I was able to put on lots of contracts. And then, like a great disciplined trend follower, I held on for dear life. And that thing went from 130 all the way up to 250, or 500 back to 250. And you could say, all right, I went from 130 to 250. That's like almost 100% return. That's pretty good. But I could also say that I went from 500,000 down to 250. That's a 50% drawdown. And if you're in the money management game, that gets it's tattooed to your forehead. You have a 50% maximum drawdown. So you're trying to figure out how to smooth things out a bit. And something that Larry said in that chapter, he became sort of a model to me, because he looked at it from the standpoint of gambling and saying you got to make your bet size appropriate. And I thought, all right, let's see. The way he's talking, he's saying making all his positions appropriate. What does that mean? And I tried to think through the math maybe. And that's where I came up with the volatility sizing algorithms that we used all during Trendstead, that I still use today. Some 40 years of using the same approach, and it worked beautifully. I think if everybody in the world used it, I don't think it would affect the world whatsoever, except to make it smoother and less risky. So I encourage everybody to look at it. $10 in my recent book that I put out like 2-3 years ago, and it sold thousands of copies. It's an easy, simple math that you learned in 7th grade, and it smooths out the results. And what Larry taught me was that, and I thank Larry for that. It allowed Trendstead to be a very smooth manager, perhaps a little boring for some, but just fine for others. We had a nice business, a 28-year run, and I'm happily retired, still using the same algorithms after all these years. So,
perfect. Yeah, we'll have that book link down below. Definitely go ahead and check that out.
Yeah.
Position sizing is so important. As you said, it's probably almost more important than entries and exits. And last time I actually had a question in mind, but I forgot to ask you. I wanted to hear your take on Jim Simon's Renaissance Technology, and what they've been able to achieve. Obviously, they're also algorithmic traders, hedge funds, amazing performance. So I wondered if you had any thoughts on what they've been able to accomplish, any insights, and just your overall thoughts on what they've been able to do.
Yeah, obviously I don't know the details of what they do every day, so I can't.
I don't think anybody does. Yeah,
they would not want that.
Yeah,
but I get a little insight into that by this most recent seminar we just did at the Phoenician here in November of 2021. What I teach in that seminar with a guy named Lawrence Bensdorf, who has one of the best, easiest to read books. I think it's called Automating Your Stock Portfolio. It's available at Amazon. Great book to read if you're at all interested in systems trading and multiple systems. So he teaches with me. He runs every day 50 strategies just in the stock market. Now, that's not Renaissance. but it kind of gives me an insight into the mentality of what
Yeah.
Renaissance might be trying to do. And that is to take a section of money. When you have that much money under management, you have a problem moving your orders because you're the big elephant and some markets just can't take it. But if you then come up with a discrete strategy and you can automate that strategy, that one little strategy might be able to handle, say, $50 million. Another strategy might be able to handle $200 million. Another one might be able to handle $75 million. Each one might be going after a different time period. There might be some that are intraday. There might be some that are looking at weekly data, some that are looking at daily data. If you want to take it to an extreme, the way I like to try to do things, you might have some markets like futures and stocks that you're doing that with. You could have ARBs. You could say, I'm going to look at the differential between hogs and cattle, and if that differential is always breaking up, then I'm going to buy hogs and sell cattle, and if it's breaking down, I'm going to sell hogs and buy cattle, and the opposite. And you're just playing how those markets are expanding and contracting and trying to pick up the movement in the spread. So there's lots of different ways that you can try to make money in the markets. And I think what Renaissance teaches us perhaps is that let's not everybody go out and try to copy what Tom Basso does exactly. Just invent your own and trying to come up with ways that you feel make sense to you and run that. But once you get that going, think about, well, could I do a second strategy that does something completely different? In your case, you were talking about a 21 and a 50-day moving average. What if you took some of the same universe that you dabble in and do a 9-day Keltner just for something totally different? You're going to get completely different signals, completely different types of equity curves, different time period, pick up different types of noise and information, and those two return streams will help smooth each other out a little bit. Take that to an extreme and you have Renaissance.
Yeah, very cool. And I think the book that I read about them was The Man Who Solved the Markets. I think it was super interesting. I don't know if you've read it, Tom, but
I haven't.
yeah, I thought it was really interesting. And also how they just recruited all these engineers and scientists. They're not going after the MBA finance guys. They're looking over, the people doing research. So I thought that was really cool.
The engineering and finance guys tend to want to make discretionary decisions. The engineers just want more data and better data.
Right, right.
And faster computers.
yeah. And something that I thought was really interesting listening to you speak is how you're always looking to experiment and try new things. So I was wondering if you could talk about that process, how you go out and study a new strategy, and how you test its effectiveness.
The easiest way that I have used in the past is simply to look at your track record. So paint your equity curve up the page, and you're going to see that it moves around. And so imagine that you're going up a road that's going up a mountain or a hill, and along the way there's potholes where you get little drawdowns, and then you can make new highs again, and then you go up here and you got another drawdown and made new highs again. And so what I like to do is to look at those little potholes and ask myself, are there any strategies out there that might make any sense to me that I could reproduce that would tend to make money during those types of markets and periods?
Right.
Not so much worrying about what it does during the other periods, but right now, let's just focus on the pothole. Can we fill that pothole at least some? So, for example, to make a real simple one, say you own a long stock portfolio and it's a sort of a buy and hold, or maybe at least a very long-term hold strategy in stocks. You're basically long, or you're out of some stocks and in some cash. So you look at that type of strategy, you're going to tend to make a lot of money when the market's going up. You'll tend to hold your own and go sideways when it goes sideways. when the market's doing a 50% down bear market, you're going to get hit pretty hard.
Mm-hmm. Mm-hmm.
All right, that's going to be one of your potholes. So now if you ask yourself, all right, let's see, if I come up with a strategy where, let's say, on a 21-day Danchin, I'm going to sell a S&P 500 futures contract against my portfolio. All right, so if I, without having to know anything about futures, understand this: if you short the S&P 500 index, it's going to make money as the market falls. It's going to lose money when it goes up. Your portfolio is going to make money when it goes up and lose it when it goes down. So what do you got going here? You got two things in your portfolio. They're going to fight each other. If you've balanced it fairly well, and you will never get it perfect, that pothole is going to get smaller.
Right.
So that's a simple example. Now take it to an extreme and do 8 strategies and 50 different positions, and you've done even a better job perhaps of trying to deal with sideways markets and down markets and on that. That's why Lawrence trades 50 different strategies. He's trying to fill those potholes.
Right. Makes sense. And do you just kind of use a standard pen and paper to try to identify buy points and sell points, or do you use kind of proprietary software to investigate these strategies?
To investigate, what I do is I usually use anything from spreadsheets to some trading platform that I'm working on with another guy that's building the code for it that will not be out anytime soon. We're still trying to get it to the point where I can run it successfully, but I have done some work on it, to sometimes just making notes and watching it each day and keeping a log of what my idea would do for a while before I even try to go to a spreadsheet and simulate it, the rules, and try to get some data and run it against there. I also will use, like, Trader Workstation at Interactive Brokers can have an indicator. If it's an indicator that's a packaged indicator, you could apply it against back data and get, just by scrolling through your screen, you can see lots of history and how the indicator would react to that market and get an idea. I already know pretty well in my brain, having run as many studies as I've done over my lifetime, how my position sizing will affect it. So I don't have to do an exhaustive study at this point in my life. I'm not sure that most new traders would have, my brain to be able to do that, but that's kind of the way I go. I come up with the concept, and I think this concept should make money during that pothole period. Then I start articulating what the rules would be. I usually use actually a Word document, and I just start typing. I put a title on it just so that I know what I'm talking about. I give it a name. It's like I have 8 children and I love them all, and they all have names. So I give it a name, and then I say purpose of the strategy, and then what kind of markets it's going to trade, and I start describing the math and the logic that I think might work. Then I go and try to actually explore that. That's kind of the process.
Right. And you've said that right now you're working with 8 different strategies. How often do you actually come up with a new strategy that completely replaces or adds to your system, or is it usually just kind of little tweaks to existing systems?
I would say the more strategies that I've got, or systems, if you want to call them that, I'd say it's harder to come up with something very, very different that you can get excited about. You're sort of doing variations on themes with different markets. Like, I just recently added a Bitcoin futures strategy. So it trades one thing, Bitcoin futures, and it's got its indicators. It's done 3 trades since I started it up. All 3 have been profitable. I'm sure I'll have losers. I know the math. I guarantee you I'll have losers. Try to do position sizing with it. I'm using the micro contracts. I'm not even using the full scale Bitcoin contracts. Just to tip my toe in the water and test the temperature and see how I feel about it. So far, so good. But In the last year, 12 months, let's say, I might have added 3 strategies, I guess, something like that. And a lot of that had just because I had a lot of time during COVID to think up new strategies.
To tinker, yeah.
I couldn't go anywhere, so I'm stuck at my desk, which wasn't a lot of fun for me, but I did make it productive.
For sure. And when you're trying to develop a new strategy, um, what are kind of I think I've asked you this before, but what are the kind of performance metrics you judge a strategy by? Because obviously, just going for a win rate of 90% isn't actually usually the best way to go. So I'd love to hear your thoughts on that.
Yeah, the two sides of it would be if you're trying to go after a strategy that makes money during sideways periods, and you're into the chop, you're into more of a mean reversion. You're expecting the market to be high, so you sell it, or it's
Right.
low and you buy it back. And you're expecting the market to always come back to the mean,
Hmm.
and that's why it's called mean reversion. Those strategies, you've got to be striving for 55, 60, 70% if you can get there, because the edge is very, very small on each
Right.
trade. You're going to get losers to winners are going to be much more on average close to each other in size. So you're going to need your reliability of the trades to be very high and then do a lot of them. So more short term, more high percent profitability. The the actual edge you'll find is going to be very, very small. And if that edge goes away, you're immediately on the wrong side of it.
Right.
Trend following, especially long-term trend following, where you're trying to pick up those huge runs, is a little more flexible. You could be down if you're taking five and let's say 5 and 6, 7 times your average profit to your average loss. You can start getting down in the 25% successful rate on your trades and take 3 trades for every one loser, or
Right.
excuse me, three losers for every one winner, 25% reliability. You can make a lot of money doing that. I did it all my life.
Hmm.
That's closer to what Trendstat did. We ran probably around 33%, give or take a percent or two, with most of our stuff over my lifetime. So that's 2 trades for every one, 2 trades losing for 1 trade winning. And you got to get that into your head. You can't be distraught over the fact that you do 2 losing trades for every 1 winning trade, because the winning trades are making a lot of money, and the
Right.
2 losers you're cutting loose pretty quickly. And as long as you get that mentality right, then you can execute that all day long. You just got to wait for the winning trades to come along. You just got to do enough trades to see them happen.
Right. And I think that's a misconception that especially a lot of new traders come into trading with is you have to be right 75, 80, 90% of the time when in fact a lot of the people who I've interviewed, I think their win rates are near 50 or below 50 and it's like
Yeah,
you said it's the making 3 to 1, 5 to 1, 7 to 1 versus your risk. That's really what's important. That's what
yeah,
basically gets those huge winners over time compared to your small losses.
absolutely. I couldn't agree more.
Right, right. And obviously, you're known as Mr. Serenity. You've got a great calmness with how you speak. I'd love to hear.
I have this peaceful scene behind me too.
Yep,
I thought I'd get into the spirit of it.
matches the theme perfectly. Yeah, I wanted to hear any advice you have for people who are dealing with a lot of stress when they're applying a system, discretionary or otherwise. And yeah, any thoughts on how people can calm down and just yeah, follow their own rules.
Well, follow your own rules. First of all, the first thing I say about stress is that there are stressors, or what I would call potential stressors, that will hit you as a human being. That they're everywhere.
Yeah,
There could be bad traffic. It could be something your spouse said to you. Any type of thing. If you allow that to come into your body and say it's stress, then you have some power over that. You can say, all right, well, traffic's bad. Let's turn on some chill radio and just enjoy the beautiful blue sky over my head or something. There's lots of ways to shift your mental state from
right.
being frustrated, being stressed, to being more in balance. by how you choose to approach that stressor. So that's the first thing I'd say. Think about that. The second thing comes from the mechanics of your strategy. A lot of people, especially new traders starting out, how many people have written me emails or something that say, I'm trying to figure out how to deal with $1,000 portfolio, and I'm going to be trading currencies, FX, and what suggestions can you give me? And my first suggestion would be is make it $2,000. Work real hard, work in a second job, make your portfolio grow, because you're dealing with such a small amount. You can't diversify it. You can't position size it. It's really tough to do anything. You'd be better off to just work a second job, go deliver pizzas or something and put that money in your portfolio and, maybe get it to 5, get it to 10, get it to some place where you have a better shot at success. Now, in doing that, if you pay attention to position sizing and you work out a strategy that is a little bit less risk, maybe a bit shorter term, so that your risk numbers per trade go down because it's a shorter term strategy. And if you can position size that properly with a very low position sizing algorithms, then you can trade a little bit smaller amount of money, but you can do it with a little bit more smooth performance, a lot less aggressive moves up and down and all over the place. You're not going to see those wild swings. Those wild swings are what's going to push your button. So the more you can make it into a smooth line, make life a little easier, the less potential stressors try to hit you, the easier it is for you to react to it, and you become more serene in the process. I guess the last item is to think about trying to diversify, not just by portfolio. A lot of traders put labels on themselves that are inappropriate, like I'm a stock trader and I just trade tech stocks. Right? So now you cut your universe down and you locked yourself on to your moving average and you add your discretion, and that's all you do, and that's all you're ever going to do. And you don't even spend 10 minutes thinking, what would happen to my results in my portfolio if I took this much of my portfolio and I allocated it over here to 10 futures markets that are very liquid, that have very different return streams. And I could do the same 21 and 50-day strategy over here with these guys, and they'll act different than the tech stocks, and they're going to smooth each other out. And now, aren't you getting less stress? Because the smoother you make it and the more sort of games you have that you're playing at the same time, the more your attention doesn't get focused in on that one that's just slamming you today, that wants to stress you out. When I have a position that's going against me, and I had one today, it was pulling my total portfolio down by how much? Probably 0.2 or 0.3% all by itself. All right, that's a pretty big chunk of money coming out. Was I stressed? Not in the least, because I had 49 other things in the portfolio doing all sorts of other things. I actually had a very profitable day despite that one market clocking me. So am I stressed? Not really.
Perfect. Yeah, that's a lot to think about and really helpful advice, I think. And do you also employ any kind of meditation, visualization, anything outside of trading to also just lower your general stress levels? Golf too, of course.
I don't. I tried like meditating, as in, and sit there and try to let my mind go blank and all that. I found that stuff bubbled up, and they were interesting things that bubbled up. And I think that's the point of doing some meditating, is to observe what those things are. However, what I find most useful is trying to kind of watch the movie, and I'll describe what that means to me. If you were to imagine, and I recommend doing this in a safe spot where it's under a controlled condition and you can't hurt yourself or anybody else. So let's do an example of brushing your teeth. You're in front of a mirror in the bathroom, and you just say to yourself, with the help of the mirror even, I wonder what it looks like to really concentrate on me watching me brush my teeth. So part of you, your brain, is sitting there going, okay, I got to get back here, and I got to get back there, and I got to go down here, and I got to go inside, and I got to go up, and I got to do the roof of my mouth, my tongue, and whatever else I've got to brush. But another part of your brain is sitting there watching you do this on the mirror. So it's kind of like there's two parts of your brain, and that's what I call awareness. And that's what a lot of people who meditate try to get to. And I think some of the things you can do in your everyday activities can get you there. Perhaps, or at least for me, it worked. I can increase my awareness by just observing what I do every day as I do it. It is sort of this weird dichotomy of doing things and watching yourself do it. And when you do that, it becomes highly, I don't know, educational to dealing with stress, coming up with trying to find that peace, find that, because when you're watching a movie, if you actually go to the movies and watch the movie, you can kind of choose to be humored by it and laugh. You can choose to be horrified if it's a horror flick. You can be thrilled when you go to an action flick and watch things blow up and whatever, and the good guy wins in the end against all odds. You're entertained. And sort of, if people would take the time to try to watch their life as a movie, it's sort of entertaining. You see a lot of bizarre stuff. It really puts a different spin on a lot of things, and it sort of extracts you, just like you would in a movie. You're not out on the battlefield with things blowing up around you. You're just watching a movie, and you know it. You're safe. You're in your seat eating your popcorn. Well, if you do the same thing in your own life, you're sort of, this is very interesting what's happening here. And I wonder what Tom should do about this problem. You sort of dissociate from the pain of it and the stress of it and all that, and you can kind of think logically. So that's been a trick I've used over the years.
Wonderful. I've never heard anybody say something like that before. So that's super interesting. That's really cool. And just to kind of wrap things up a little bit, Tom, I wonder if you have any kind of general advice for people who want to start a trend following system or want to improve the existing strategy they have.
Well,
I know that's a big question.
That covers a lot of ground, but I guess the first thing I'd point to is the book with trend following on the cover, which is Michael Coville's great tome that could be used also to hold your door in a stiff wind open if you needed a doorstop. It's a heavy book. It's not inexpensive, but it's like yay thick. And you can wade through all sorts of stories about people that have used trend following, famous traders, the concepts of trend following. It is a compendium on trend following, so that's a good place to start. Other places that you can play with would be, when you go on your broker platforms like Trader Workstation in the case of interactive brokers, but Schwab the same way. Other Investopedia.com has got a lot of them. What you can find happening is they'll have categories, and you can see trend following as a category, sort of, or a trend indicator. All of those indicators in some way are measuring trend. And they're just measuring different aspects of it, and play with it and try to understand the math behind each of those, and ask yourself, do I understand this, or is this really obtuse and I don't really like it? So a simple moving average crossover like what you described earlier, 21 and 50, that's a pretty easy, it crosses over, I buy. It crosses over the other way, I sell. There's no doubt. It's very simple, easy to calculate. Always will pick up every major move. That's one way to look at it. But you could explore things like Keltners. I like Keltners. I like Donchins. I like Bollingers, although the math is a little bit more difficult because they have standard deviations in there, and that scares people. Those are probably my three easy to find, usually available on most platform types of indicators. There's some other more strange things that you could get into that I don't think are that much better than the three I just mentioned. But I'd explore some of those and just try to understand the math and put it up on the screen and put it against some of the things you trade and get experience and start seeing where does the price actually hit that spot. That's where I would buy. That's where I would sell. Ooh, that would be a nice profit, you know? And I think you get a feel for it that way. And, oh, over here, I'd sell out here and I'd have to get in even higher. And I'd be over here, I'd buy in and I'd have to take a loss. So you kind of get, by living in the past and looking at the exact trades, you kind of are sort of living trade by trade with how does that feel to take that kind of loss? How does it feel to be in on this long trade and have to sit there and do nothing for 2 months? Am I too impatient to do that? Do I need to speed this up so I have more action because I can't sit there for 2 months and watch this thing make money? Some people are that way. You got to match what you're doing up to your personality and your skill levels and everything. If you don't, you're just struggling all the time. So I think that's the way I'd approach it. That's a good way to get into trend following. And listen to interviews like this one. I've talked a lot about trend following here. I go to enjoytheride.world on the interview page, and you'll find dozens of hours of Tom talking to various people, and a lot of it's about trend following. So.
Perfect. Yeah, excellent advice. And we'll have the link down below to that as well. And I want to ask you, are there any other resources that you recommend that you put out? I know you just had a workshop and you've got another one planned next year. So feel free to talk about that.
We don't have it completely planned yet, but we've targeted somewhere in March or very early April. Probably won't be April. There's an outside chance it would delay to May, but we're thinking sort of Miami, and we're thinking 12 people total, so it'll be an intimate group, and we think the country is going to be more open to people coming from Europe because we've got a huge waiting list, not only in the United States but Europe, and we might be able to fill the seminar off of our waiting list. I'm not sure, but we'll announce that publicly after we give the waiting list people a chance to, if they want to pass on the waiting list or not. And then we'll announce the rest of the seats, and we'll hopefully have a full house like we usually do. So, and we'll cover everything. Oh my gosh, we just finished one up, and it was so much fun for Lawrence and me. We met some fascinating people and a lot of good questions, and we had a good time.
Awesome. And I'll also have your Twitter link below, but is that the best place for people to reach out to you if they have any questions?
You can find me on, if you put in Tom Basso on Twitter, Facebook, MeWe, Parler, and LinkedIn. I'm on all of those. And you can reach me anywhere. You can go to enjoytheride.world and keep in touch page allows you to put your email address in there. And I usually will announce to the people that have come to the website that we're holding another seminar every now and again. But the website's got a lot of, very inexpensive or free information on trading that I think would help a lot of people if they just spent some time reading some of the research papers, reading or listening to some of the interviews, checking out some of the books I recommend. Those are in order the way I would recommend them. Tharp's great book on Trade Your Way to Financial Freedom is a classic. I love it. There's just a lot out there, and to try to start as a new trader and look at all the different resources, it's overwhelming. So you just have to start crossing off the list one at a time, and that's all you can do. It's only so many hours in the day.
Right. Awesome, Tom. It's been an absolute pleasure. Really enjoyed picking your brain on all these different stuff. So thank you so much for taking the time and speaking with me today.
Yeah, it was fun, Richard. Thanks for having me.
My pleasure. And to everybody watching, I hope you enjoyed as well. Remember to leave a like down below if you did, and subscribe to the Traderline channel. And we'll see you guys in future videos. Thanks. Welcome to the Traderline podcast. I'm your host, Richard Moglen. Each of these episodes will feature a top trader or investor, such as market wizards and U.S. investing champions. Make sure to listen carefully as they share their stories and techniques that have allowed them to master their particular styles. This podcast is sponsored by Traderline University. Click the link in the description to learn more about exclusive experiences such as the Swing Trading Masterclass, where you can learn directly from Oliver Kell, the U.S. investing champion. In this masterclass, Oliver explains his method comprehensively and walks through specific examples of his trades. Also, be sure to check out the Leadership Blueprints course, which will level up your technical analysis abilities and teach you proprietary edges and techniques you can use to identify and manage true market leaders. And with that said, sit back, relax, and enjoy. Hello everyone, welcome back to the Tradeline Podcast. I'm your host, Richard Moglen. Joining me today is a very special guest, Jack Schwager, the author of the well-known Market Wizards series, with most recent edition being Unknown Market Wizards. So, Jack, it's a real pleasure to have you on here. Welcome to the show.
Yeah, thanks. Appreciate it.
No problem. And to start things off, I'd love to hear about kind of the story behind the series. So could you tell us a little bit about your background, how the Market Wizards series came to be, and the whole story behind that occurrence?
Sure. So the idea for Market Wizards, the original one, was something that I had for several years before I actually did the book. The genesis is probably that I took a sabbatical to write another book before Market Wizards, which was a complete guide to the futures market, which is a different type of book. It's an analytical book. It's like almost 800 pages. Like I say, I took a sabbatical to do it. It took a whole year to do it. And I was just trying to write. I didn't think at the time, this is back in 1984, I didn't think there was a really good general text on analyzing the trading, the futures market, so I figured I'd do it. Mm-hmm. And that got me started in writing. Although I was writing some articles before then, but that was the first book. And I got approached a couple of years later by an editor, have lunch with an editor from a different publishing house. They liked the book and they wanted me to do a whole series of analytical books. And I said, thanks, but no thanks, did it once and no desire to do it again, although I did end up doing it again. But at that time, I didn't think I was going to, because you do a book like that for only one reason. It's not to sell copies. The more, actually, I sort of have a rule that the more formulas you have, the less copies you'll sell. And mm-hmm. It's sort of, actually, the more intense you make the book, it doesn't work if your goal is to sell a lot of books or make money. You don't want to do that type of book. But I wanted to establish it as myself as writing what I thought was a good, really good, solid text. Right. But subsequently, what I want to do is really reach a wider audience, which that book is more specialized and really for traders who are really serious and maybe some people with a little bit of analytical background. And I wanted to reach a broader audience. And I knew some really good traders, like Michael Marcus is the first chapter. In Market Wizards, I also knew Bruce Governor, and so I thought that this would be a good idea. And mm-hmm. So when I was pitched with the offer to do this series of analytical books, I said, not interested, but I've had this idea. And the reason I didn't do it is because at the time I was a research director, which itself is kind of a full-time job. And sort of, it's well more than a 40-hour week by itself. So writing a book on top of that it really is a strain. But I thought it'd be a good idea, and I didn't want to do it at some level. So I tossed this idea out, and the guy said, sure, do it. So that was the catalyst. And basically nights and weekends is when I wrote the book. So the interviews themselves really, other than some of them required trips, different parts of the country, but a number of them were in the New York area, which is where I was. So the interviews themselves are really not what took a lot of time. It's really the actually putting the book together, which is what takes the time.
And outside of the traders you knew, how did you decide who to actually interview for that first Market Wizards book?
So one thing I did was every time I interviewed somebody, I asked them who they thought I should interview.
Right.
So that was helpful. That was a good thing to do. And I knew some people like that I didn't know personally, but I knew of them. Mm-hmm. And so I don't think I knew, like I say, Marty Schwartz. I didn't know personally, but I was aware of him. Mm-hmm. And somebody like Jim Rogers, I knew, wasn't that far after he had left George Soros, the Quantum Fund, kind of knew him by reputation as well. So there were some people that I knew of that I thought would be good interview subjects. And between the ones I knew, the ones they recommended, the ones I knew of, I basically had, the core of the book, basically.
Gotcha. And I do my own interviews with traders, as I just mentioned to you before we start recording, and I find it's quite easy actually to ask good questions because you've already got a little bit of experience, you know what's going on. Can you talk a little bit about your own personal investing and trading background and how you develop that kind of specific knowledge, which then you could go out and ask these market wizards and learn even more from?
Right. So I had good market knowledge. I wouldn't say I certainly wasn't a good trader. In fact, one of my motivations for doing the book was, hey, it's a good way to pick the brains of some of the best traders around.
Right.
So there was that motivation. Hey, it might help my own trading. So it wasn't that I was a good trader, but I understood markets, and I'd done a lot of analysis. So regardless of what method the trader used, I could usually speak intelligently about it, whether it was technical or fundamental or whatever. So it was that background that was useful more than, and I had traded, but it wasn't any trading expertise for sure that was helpful. The one thing I did, I probably did it from the beginning. I certainly have been doing it, in other market wizard books, but I think I probably did it from the beginning, was to, that even though I had a list of questions, they were just kind of the safety net. I didn't go in and like flip cards. I had a little stack of index cards, but what I would do, and what I still do, and what I think is really important, and it's advice I give people who do what I do, is don't go in with a set of questions that you're going to check the boxes, right? Because the worst type of interviews, and I've been on the other side of a lot of interviews, but the worst interviewers I have, where somebody comes in, they ask a question, and no matter what you say, they go to the next question. It's like you can just hear the checklist,
They're less organic.
They're not engaging. So the most important thing is have a conversation. And the most interesting things that ever come up in the interviews don't come up because of questions I ask. They come up because of answers people give, which then lead to other questions, which eventually leads to something. So it's really important to approach these things in having an engagement with the person, not to go in with a set of checks to fill, And so that's kind of the most. It's not, I wouldn't say it's a lesson I learned. I think I did that instinctively from the beginning, and it's something that I think that I did correctly, and I've never changed.
For sure. And while you're doing those interviews, were you ever very apprehensive about approaching somebody, or actually during the meeting you were kind of extremely nervous and scared because some of these were very established traders and fund managers? So I just wondered if you ever had that type of experience.
Yeah,
for the first book especially.
Yeah, I guess I've never been intimidated. I've certainly felt that people I interviewed were just, way smarter, way better than I am. But I always felt that I was good enough to have the conversation,
Right.
So I always had enough confidence that I could talk to almost anybody if it's a subject that I have some knowledge on, and not come off like somebody doesn't know what they're talking about. Nor do I pretend. If I don't know something, I don't pretend that I know it.
Right.
Which I think is another important thing. If I ever get questions, sometimes people ask me a question, and it's hey, not my area. I don't know. So I never try to fake knowledge. So as long as you stick to areas where you have solid footing, then no, I can't say I was never intimidated. I was never nervous. I was anxious in some respects in certain interviews because there was a certain pressure element. So, for example, Tom Baldwin, who was kind of maybe the most famous certainly one of the most famous floor traders of the time, of the era, when I was interviewing. So this is a guy who would be in a T-bond pit, really trading like these huge size, and aggressive, and certainly known by everybody.
Mm-hmm.
Now he didn't want to do the interview. I'd interviewed somebody else, Brian Gelber, who was a trader in his own right, had his own trading shop, and he was a friend with Baldwin. I think he may have pushed Baldwin a little bit, or at least got him to agree. And I was in Chicago when I interviewed Gelber. It happened to be St. Patrick's Day, and first of all, Baldwin didn't want to do the interview, and so I had to wait till first of all the end of the trading day. Comes up to his office, and so, and as I'm doing this interview, people are coming up and they say, when are you going to be at the bar? It's like,
right.
He's like waiting to just go and have drinks with his buddies. He doesn't want to do the interview. And I kind of know that the minute, I have like 3 seconds between a question, another question, he's gone. And so every time he answers, like as soon as he finishes, I've got enough. And again, I'm not working from cards, so it has to be impromptu, so I can't hesitate. And so that was kind of pressure, because I knew as soon as I had any hesitation at all, he's gone. And it's exactly, I think I used the analogy in the chapter. I think I used it with something like you're trying to take a picture of a bird on a wire, and the slightest move, it's gone.
Yeah.
And that's the way I felt. I felt he was like a bird on a wire, ready to fly off. And sure enough, the first second I hesitated, he was gone. So that was kind of like that was an interview that I remember because there was pressure. And it was kind of thinking. There was another interview. That was the one I kind of think is the best example. Where there was some pressure during the interview. There were interviews like Bill Lipschitz, which ended up, it was a currency trader, ends up being first chapter in the second Market Wizard books, New Market Wizards. Now, sort of, I know he had interesting stuff because he traded for Solomon. I knew he traded billion-dollar positions. So I'm talking, a guy who's going to have some interesting stories. And, we talked for a couple of hours. He's just not going anywhere. This is going to be like deadly. And then we break. He ordered some Chinese food. We break. We're having the food. And then he starts talking, the tape off, and then we get back on. But, and the tape, and again, but it took literally, I think, everything in that chapter probably came after about 4 hours of interview. So like literally the first 4 hours of the interview ended up being tossed. Yeah. And that was kind of an extreme example of that, but that happened in a number of interviews where you just have to keep at it until you start getting something interesting. And so now, you don't have this luxury. You do a podcast, you've got to get it right when you're doing it. Now, when I do the book, one advantage I have is, sometimes I've done as much as 10 to 15 hours of interview, to get to distill it down to the book, to the essence of the book. So that gives me the advantage of being able to extract the best stuff and to mold it and sort of, which is something you don't have when you're doing, an interview like a podcast interview. So that's one advantage that I have in the types of stuff that I do.
And I wanted to ask you whether there was one kind of favorite question that you love to ask all these top traders and investors that you always found that there were very interesting responses to.
Yeah, my favorite question is, what's the worst trading experience you ever had?
Yeah.
That's my favorite question. Because for two reasons. One, it leads to the best stories. And two, it leads to the best lessons. Because people learn the most. You learn the most from the mistakes you make.
Right.
And most traders, if you ask them, what's your best trade? Kind of stumped, They had so many trades and so many good trades. But you ask them the worst trade, they'll usually remember the worst trade or their most painful trade. And it may go all the way, and often it goes all the way back. You talk to somebody like Ray Dalio, who ends up, managing, being in charge of the largest hedge fund ever, and probably, Bridgewater, at least at the time I interviewed, I haven't come up with the statistic, but at the time, they had made the most amount of dollars for investors because it's a combination of he didn't have the best performance, neither in return nor return risk, but the combination of having a huge, like a mind-boggling amount of money under management and yet delivering substantial returns on that combination made him like in his own sphere. Right. So that's why I say that's why he ends up having made the most money, at least at the time, for investors of any hedge fund that ever existed. So somebody like that, and he has all these years of experience and running the hedge fund. But if you go back and ask him but when he starts talking about his worst experience, it's back when he was like sitting, I don't know if he's a broker, I forget, he was a trader or broker, whatever, but he wasn't managing a hedge fund or whatever. He's kind of trading his own account. And he remembers a time he was long pork bellies, and every day, and he talks about, this is only people as old as Ray and myself know this, or work in that environment, because when we came into the business, forget computers, with electronic screens, and we had literally these big, when you worked in a large brokerage firm, you had these wall-sized boards that the prices would change, and you would hear the clicking, every time the prices change, or the clicking of the prices changing. And when he talks about being in a long pork belly position, and every day it was some sort of report, and every day the market opens up, limit down, and it's like clicks down, limit down. And he talks about it's like an electric shock of that experience. And it's very visceral because you have the sound of it and the whole thing. And I could really relate to that because I know the exact environment he's talking about. But the interesting thing is when he talks about his worst experience, he goes all the way back to those early days.
Yeah.
And when he was losing, who knows, probably a trivial amount of money. Because to him it wasn't trivial, but it was on account, maybe in a couple of contracts. And he doesn't talk about when he might have been losing billions on a trade because of the size he was trading. It's when he was losing thousands on a position, but it was that experience of being stuck and not being able to do it after he made the mistake.
Right. You learn the most when you're making the mistakes and are in your formative years as a trader.
Yeah.
And so a lot of our audience at Traderline are kind of growth stock traders similar to William O'Neill or David Ryan. So I was curious if you remember any tidbits from your interviews with either O'Neill or Ryan that would really stand out to people, or you think they would find them interesting.
Well, I mean, the main lesson, and this is you get if you read their books or listen to them. I mean, their approach. I mean, it's a lot of things a number of things that are involved, but the biggest thing they've done is to go back and look at what are the profiles of the winning best winning trades, and it usually will involve buying stocks that are going to new highs and stocks that are among the strongest. Actually, so it's got to be an approach that feels right, that works for you. So it's difficult to do because you're always buying stocks when they're at highs, and you could be subject to a lot of times false breakouts and stuff like that. So you've got to have the attitude and profile where that type of approach works. But that's from what I think what's maybe most important to their approach, it is that element of buying strength and looking at the profile of those things that went on to be the biggest winners. And that's opposite of what a lot of people do. That you could do the opposite thing and still be successful. It just means that it's a certain type of approach that is only going to fit certain types of people. So that's what I guess sticks most in my mind about, both of them and their approaches.
Right. And during the interviews, were there any special stories that came up or really significant?
Actually, with Bill O'Neill, that's what I really remember. What I remember is, here's a guy who owns the company, who's made, God knows how many, tens of millions of dollars.
Yeah.
And, even at that point, he was well on in years,
Yeah.
So I kind of picture, I kind of imagine I'd be, interviewing him in his nice office or whatever. And I mean, there he is, like in the middle of this room of other traders, and kind of, talk about low, like, like, low rate. It's like the stuff would have been rented from a surplus place.
Right.
Really, you talk about unattractive offices and environment. So it was interesting to me that all that, even though you think somebody like that would, it's like, might as well have a nice, and then it didn't register. It just was like, and the same thing, by the way, with somebody like Steve Cohen.
Mm-hmm.
I remember the exact same thing. So when I interviewed Steve Cohen, again, here's a guy, man, he's made billions. And again, he had his office, but when I interviewed him, he's on the trading floor.
Right.
And you couldn't, if you didn't know what Steve Cohen looks like, you wouldn't have any idea who Steve Cohen is, because there's a big trading floor, and kind of in the not exact middle, but sort of in the midst of this is a desk, just like all the other desks. And there's Steve, and it's like a bunker. Like a large bunker, because there's no windows. It's not exactly, an attractive, but he's just kind of in there with the troops, basically. And sort of, so I kind of remember sometimes, because you have this image of what these traders' offices are going to look like and whatever, and they could be sometimes so radically different that that's what sticks with you as a mental image.
For sure. And obviously, you've interviewed investors and traders of completely different styles, buying strength, buying weakness. Were there any commonalities, especially when it comes to their mindset and approaches, that really stuck out to you that you think kind of led to their success, regardless of their strategy?
Yeah, well, mindset, the mindset of a trader, there is a lot of commonality. First of all, personalities, no,
Yeah.
you have people who are like drill sergeants, and you've got people who are kind of quiet, almost shy.
Mm-hmm.
You're very soft-spoken. And you got people who are really nice. You got people who are rude. You've really got a kind of and you've got left wing, you've got right wing.
Mm-hmm.
You got personalities. It's just like if you took a random sample of people, you would get, and education. You've got PhDs or near double PhDs in math and physics, and you've got people who didn't finish who finished high school and not with very good grades.
Right.
So you've really got all that's different, but the mindset that I think there's a commonality of kind of an intensity of focus
mm-hmm.
on the trade of trading,
mm-hmm.
as a trade, as an endeavor. The ability to lock out the emotional side, to treat it as a task without letting your human emotions get in the way. There's one exception I can talk about, but essentially, as Bill Eckhart, who is Richard Dennis's partner and his CTA in his own right, as he pointed out, he made the very nice point that people are so poorly attuned to trading in terms of the way we've evolved our natural instincts that people will do worse than random. And so people are not confused. He's led it with the cliche about monkeys throwing darts at the Wall Street page and doing this as well as professional traders. Eckhart's point is, no, the monkeys will do better because people's instincts will actually lead them to do worse than random. That worse than random is really important. And so the people who are successful are able to not react to this, the emotional side, and to be very focused, to be very prepared. And in this latest book, Undiscovered Market Wizards, probably, Unknown Market Wizards, mm-hmm. probably more so than in any other book of the series, you get this so many of those traders that make such a big point about being in a right mindset, and if things not going right, close the book, walk away, come back next day or whatever. To be really, to do mental preparation before a trade, to get into a state of flow, to get a state of focus. All of these things, you see this repeatedly, how important the psychology is to the art of trading. It's not just a matter of intellect or approach or even money management. That is really about having the right mindset to execute and to be aware of your own weaknesses and like one trade like Richard, there's not actually a few traders who do this, but one who's kind of exemplary at it, like Richard Barge, who will like keep a spreadsheet of a number of different types of emotions, and every day, whenever he's committed any of those emotional sins, we'll make a check, and at the end of the week, we'll look at the spreadsheet and see if any column has more than a couple of checks, and know that's an area where he has to work on. Besides also keeping notes on all of his trades, so you see this is kind of common ground. You see this respect for learning from mistakes that comes up again and again and again.
Right.
A number of traders in this book talk about, and not only talk about it, bring out these 1,000-page binders with notes on all the trade, the trades, their emotional state. You can see this is a really serious thing. And the point of that is they're trying to learn from what they've done right, more importantly, from what they've done wrong. And kind of the king of learning from mistakes, one who makes it maybe most instrumental. And a number of these traders actually, in fact, one trader sort of idealizes it, is somebody I spoke about, is Ray Dalio. And Ray Dalio's maybe guiding philosophy is you have to learn from mistakes. And he does his philosophy not only in trading, but in general. In fact, he kind of makes a nice point about our educational system, how it's misguided, because it's always geared to getting the right answer. And his point is, you don't learn by memorizing the right answer. You learn by trying to get the right answer, making mistakes, and seeing what you did wrong and going from that. So, but that kind of permeates his whole philosophy, and certainly Bridgewater is built on that. And according to him, at least, the development of their trading model is totally a function of their having incorporated mistakes into improving the model as years went by. And so you get that in this book. And like I say, one trader, in fact, there's a story about Daljer Dhaliwal, who kind of bid to have lunch with Ray Dalio. And I won't go into the whole story, but we'll just leave it at that, whether he got the bid or not, because it goes back and forth a few times.
Right. And I am curious, though, you said they had tons of different personalities, but was optimism a common thread among them, or really there were pessimists, optimists everywhere along the spectrum?
I wouldn't say it's pessimism. I think it's confidence.
Yeah.
And sometimes confidence that seems almost misguided. So if you look at somebody like Marcus and that first chapter in that first book, and you go through his early, his trading experiences like a litany of failure after failure after failure. And I literally asked him kind of midway, hey, did you ever think it's just maybe this isn't your thing? Maybe you're not suited for this thing. And somehow he said, no, I just felt that I could do it. And he did. He went after blowing out a number of times, including, and he came from a poor background. His mother, his mother had like a little bit of savings, not much. And he even borrowed money from his mother and blew most of that. I mean, you couldn't get lower than he got. And he goes on eventually to finally figure it out and finally develop his method. Of course, risk management was a big thing that he didn't have initially, that he eventually got through these experiences. But he goes on and then turns a $30,000 account into $80 million. So, so it's the confidence, even if it seems misguided. There's some sort of burning confidence in these people, and they just really believe in themselves and their ability to succeed. So I don't know if that's optimism. I would just term it more optimism rather than confidence rather than optimism. Yeah. And pessimism, I don't think pessimism would work to be a successful trader, because again, it would fight the confidence element of it.
Right. And I'm just kind of curious, do you think anybody has what it takes to become a trader at the level that these people are, or you think that inner confidence is something you're kind of born with versus what you can develop over time?
Well, confidence is maybe, it's not just the confidence, it's kind of the particular skill or combination of skills that's required. So the answer to your question is no, I don't. For no more than if you ask me, do I think anybody could become a solo violinist with a major orchestra if they practice enough? I'm sure they couldn't, because
Yeah.
there is some sort of innate talent there. Could anybody run a world-class marathon time? No, they could run a marathon, but they won't run a world-class
Right.
marathon unless they were born with the right body. People who don't have the right body, no matter how hard they train, they'll never be able to do it. It's just physically impossible. They can do very well. They might become the best runner of their weight or body frame, but they can never be world class unless they have a certain body type. Right. But I think trading is the perfect analogy. I don't think anybody can become a Mark Wiz. I don't care how dedicated you are, but it's a combination of a certain type of innate talent, and a talent could be different. It could be somebody like if it's somebody like a Michael Marcus, or in this latest book of Jeffrey Newman, just seem to have a kind of a real instinct for picking up trends early,
Right.
and it's just a skill. And like in Michael Marcus's case, I kind of make the point where there could be 100 things affecting the market, but his skill was to know which of those 100 was the thing that really mattered. Right. And I might be trading the same market. I might have analytical economic background and all that, know a lot more than he does in a sense, but he's going to be right and I'm going to be wrong, because he knows which is the item that the market is going to pay attention to. And that's kind of a skill. And like Newman sort of in his latest book will pick up these trends when they're really nascent, and he'll ride these things and he'll literally make sometimes even, to get 10 to 1. He has trades where he's made 100 to 1. And then he'll get out and the thing will go all the way back to where it was. So I don't care who you are. I mean, he talks about how he does it. He talks about what he picks. He talks about what he tells you what he's doing. But I think, could anybody do it? No. I mean, he can tell you everything he's doing. You'll never do it because it's a certain type of instinctive skill. So you have those type of traders who have this type of instinctive skill. You have traders who are like Annette Thorpe, who are just absolutely have this combination of quantitative brilliance,
Right.
and creativity, and are able to kind of, before everybody else, figure out inefficiencies in the market and trade them for years before anybody else figures it out. So in his case, I won't go through all the things, but just as one example, he kind of figures out the Black-Scholes model, or the mathematical equivalent of it, years before anybody else does. And he's really printing money for years before the paper comes out that, the famous Black-Scholes model, and, it becomes more common knowledge and it's programmed, but he's been doing that for years. And then he goes on and he figures out, the convertible arbitrage before that's, and then people start, and in statistical arbitrage, and, like so many of the hedge fund strategies that eventually become kind of their own boxes in the hedge fund strategy universe, he's the first guy that figures it out. So can anybody do that? You can have brilliant mathematician. He may, it's not just being a brilliant mathematician. It's also he has this insight and creativity to take this math and his quant knowledge and yet see how markets can be exploited. So you have people in that. So again, it has a very special combination of both quantitative skill and creativity. I don't care who you are, only very, very few people can be able to do that. And you can go through different approaches where people have this particular skill. And, everybody's got a different approach. But in each case, they sort of got this, they found this thing that they're really expert in.
Right.
And, and they could tell somebody everything they're doing, but you're still not going to be able to replicate it.
Right. And one of the things, Jack, that I find most interesting when I talk to the traders that I interview is about their routines and how they prepare themselves to be at the best of their abilities. So I wanted to ask you whether there was one trader whose routine really stood out to you that was really surprising or avant-garde or anything like that, that really just stood out to you when you're doing the interviews?
I wouldn't say, well, I just think of somebody like Amrit Sal in
Yeah.
the latest book. And I mean, this is a guy who is, at least I did the interview a year and a half ago, but as of that time, he had like literally had an average annual return of over 300%. Now, before people, say, wait a minute, that's impossible. He's not compounding it. He's basically continues to trade a few $1 million, and, he's not, it's not like he's, keeping all the money in the account. So part of the reason he's able to do that is because he's not letting his size grow
Right.
in a way that gets in the way. I'm sure he could trade a lot more money and make a lesser percentage. But the idea is, but still, he can trade an account which is for most traders large. We're talking millions, and have like literally 300% a year average returns. Not an average 300% for the whole period, but every year. Average return. So somebody, I mean, his return risk is numbers, and he's a person who's the Sharpe ratio is really a horrible. I don't like the Sharpe ratio overall anyway because it penalizes upside volatility, and he's the perfect example. He's got so many days where he's got these super large gains, but he almost never has a super large loss. So the Sharpe ratio won't give you any idea how good he is. But something like a Sortino ratio, a gain to pain ratio, his return risk on those types of return risk measures, which don't penalize upside volatility, are literally just kind of completely off the charts. I mean, you have everybody else down here, and he's like this outlier, way off. His return to risk is just extraordinary. So, talk about preparation. I mean, first of all, he doesn't do a lot of trading. I mean, he may do some trades, but the key trades for him don't come up a lot. There may be like 6 or 9, key trades he might do in a year. And those trades are often around some sort of major event, or if it's a central bank announcement or some release of some major number or whatever. And he he does immense preparation for each trade. He will, he's been keeping notes. He's been doing this since 2007. So he's been keeping notes since the beginning on every type of situation. He got his own record of how the market has responded in all these similar situations. He'll review that. He'll know exactly what he does. He'll do no matter how the news comes out. He'll do mental preparation for the trade. He'll be totally focused. So he's somebody who does so much preparation for a trade, both research-wise and emotionally, mental-wise, that it kind of stands out as a kind of a pinnacle of how intense you could be about the craft of trading. So he's not the only one who does that. I mean, but he's a good example. If you ask me for an example of somebody that stands out in terms of trade preparation.
For sure. And you mentioned a few ratios here, performance metrics, the Sortino ratio. Could you talk a little bit about how you analyze the performance of a trader? What are your favorite metrics? And for those people who don't know what those are, kind of explain this a little bit too.
Yeah, sure. I'll give you that. So one thing is I'm not a big fan of return alone. And that's why people look at return, by itself, and a lot of people just look at that and they stop. And just to give your audience a simple example of why I don't think it's a good metric. Take any trader, or yourself. I mean, I tell traders, you want to double your returns? I tell you to double your returns. Just double your positions trade every time. So you'll double your returns, you'll double your losses. Does it make you a better trader? No. I mean, it'll mean okay, instead of, let's say you're making 20%, you'll make 40%, but then your drawdowns, instead of being 20%, will be 40%.
Right.
So it doesn't make you a better trader because return by itself doesn't mean anything unless you normalize it by the risk taken to get that return.
Right.
So that's why I tend to almost focus solely on return to risk. And as far as the most common return to risk measure is a Sharpe ratio, which takes the average annual return, divides it by annualized volatility. And so the problem with that is volatility is a proxy, but far from a perfect proxy for risk. Volatility and risk are not the same. Yes, for some traders and in some situations, volatility can be a proxy. So if you get greater volatility, you'll have greater risk. That's true if you're doing something like doubling a position. You double a position, you'll double the volatility. Yeah, it's true in that. It is true maybe for some approaches, but there are a lot of trading approaches where that's not true, where volatility is not a good risk measure. And we talked about like Amrit Saul, which is a perfect example. So here's a guy who must have like 30 days in his track record where he's made 25% or more on a single day. Okay, right. So the Sharpe ratio will hate that because it's so much volatility, but it's on the upside. And yet he has very rigorous risk management. So if he's wrong, he gets out right away. The one time he had a big trade, and I'm not going to go through the story, but the story's in the book. It's like a critical trade. He puts on the trade, and he, the announcement's being made, and then the sentence is finished in a way where it completely reverses the trade, and his computer, and he can play Microsoft here, starts powering down. It was some sort of Microsoft. Starts powering down right at that moment. So that's the one time he took a big loss. It was just like an extraordinary, bit of bad luck. But other than that, he didn't have like any large, even though he has so many big gains. So for somebody like that, the Sharpe ratio is going to give you a very misleading picture. So my point is, and so you have traders like that who have asymmetry. They have large gains, but not large risk. On the other hand, you have traders like sellers of out of the money options, and this is kind of a strategy on its own. And the thing about this is these guys will have good records for years, great records, and super Sharpe ratios. Why? Because they're selling to options that could expire out of the money in almost all cases. So every month they're making money. So you have these track records, and you can see this over and over again. You'll have these track records that look like a money machine, just constantly making money. The Sharpe ratio will love it because you have steady return. Hey, look, almost like Bernie Madoff, but it's real money up to a point. And the point is, if there's let's say there's a sudden sharp down in the market, like March 2020, or certainly 2007, 2008, or even 2011. But you get these certain times where you have these quick large breaks in the market, and then what happens is these out of the money options. Particularly on the downside, where they not only start losing in those, but those positions become larger and larger because as the market goes down, the delta goes from like 0.1, meaning they move 10% of the amount that the underlying stock or market does, to moving 0.5, half as much, 0.75, ultimately close to 1. So the position is getting much larger at the same time. Everything's going against them, and the more it goes against them, the larger it gets. So you have tons of cases of these type of traders where they've had great records, and then something like this happens, and they literally have an 80%, sometimes 100%. They wipe out completely, but it's sporadic. It's once every number of years, and that number can be large sometimes. So it looks like they have good performance. The Sharpe ratio would tell you, hey, put all your money with this guy. But the point is the risk is hidden because it's sporadic, only comes up once in a while. So my point is that's why the Sharpe ratio I don't think is a very good measure. Yes, 99% of the investment community uses that, but that doesn't mean it's right. Lots of times the majority of people do stuff and it's wrong. And it sort of self-perpetuates. And so I think it's just common sense, right? What is the measure of risk? Ask anybody. You don't have to be a mathematician for this. You don't even have to know math, but ask people, what do they consider risk? Risk is losing money. It's common sense. So if you're going to have a measure that means something that really coincides with people's perception of what risk is, it should be a measure of losing money. So you've got stuff like Sortino ratio, which is like the Sharpe ratio, but it only uses the downside volatility, the volatility on a losing side, not winning volatility. And that's much better. That's a big improvement. I'll just write a real tangent here. I'm not going to go into it. It's just that the way people calculate the Sortino ratio is wrong for technical reasons. If you want to see the answer, it's in the book Unknown Market Wizards, or you can go to fundseeder.com and look up or if you hover over any of the risk metrics, return any of the performance metrics. If you hover over on it, it'll give you the definition. And I think there's actually a separate page which gives you all the explanations. And in there it'll explain to you why the way people calculate the Sortino ratio is wrong. It still gives you the right ranking, but it makes it not comparable to the Sharpe. But if you do it correctly, it is comparable to the Sharpe. So I won't go into that tangent though. But anyway, so the Sortino ratio is a good one. And then there's one of my favorite measures, the gain to pain ratio, which again is explained in the book. It's explained in the fundseeder.com site. Essentially, you're summing all the gains and you're summing all the losses. Ideally using daily data, but you can use monthly data. Just the two are not comparable. There's a different, what's good for monthly is not good for daily. Again, that's all explained. But that idea of using a ratio of all the wins to all the losses is very good because it's basically normalizing the gains by the losses. And if you're using daily data, every loss you take counts, which is why I like it. So you can't hide anything. So even if you have a month where you end up losing 2%, but intra-month you were down 18%, that doesn't get hidden if you're using daily data. So something like a gain to pain ratio based on daily data gives you, and plus the daily data, you have a lot more data,
Right.
Because it's daily, you got
it's more granular,
22 times as much data for the same period as you have with monthly data. So that, I think, that's one of my favorites. So those two, just what I call the adjusted Sortino and the daily gain to pain ratio are my two favorite stats.
Perfect. And while you've done all these interviews, have you learned about any or noticed any common risk management techniques? Because risk management is really the name of the game. You can't trade without your capital. So what are your thoughts on risk management, and did you notice any similarities between all the different traders you've interviewed?
Yeah, well, risk management is not rocket science. I mean, you can make it complicated. There's people who've written books or even multiple books on risk management, which is kind of, in my mind, a bit absurd, because literally I can get 90, 95, 99% of risk management down, not only on one page, I could probably do it in one paragraph. I might, maybe one sentence is pushing it, but I could certainly get it in a paragraph. And the essence, and this is what you see in traders over and over again, the essence of risk management, and hey, to your audience, if you get one thing out of this whole hour, whatever we talk, just take this, and this will make it all worthwhile. The essence of risk management is just to not let yourself lose much on any given trade. I mean, that's all it is. I mean, really, that gets you 95% of the way there. As long as you don't let any trade lose much of your total equity, you're most of the way there. And it's essential in order for you to succeed. And the idea of what is not much of your equity, most people overestimate it wildly. When I wrote the original Market Wizards, I think in my conclusions, I suggested that, you shouldn't risk more than about 1%, on any given trade. And then in 2000, that was written in 1988. And then in 2012, I did a revised version where the original text is not revised, but I added a chapter saying, hey, 25 years later, whatever it was, looking back, what are my thoughts now? And I added that chapter of, how I kind of view things 25 years later. And I think the only thing I said that I would change that from the original, I mean, it really was remarkable how much of it still seemed totally valid.
Right.
And one thing is maybe as far as the maximum risk, and maybe, I wouldn't say 1%, or maybe I used 1 to 2% in the first book. I'd say it should be less than, should be a fraction of 1%. Mm-hmm. So, people think in terms of 5% or 10%. No, that's way, way too much. Literally, we're talking 1% and under in terms of
Right.
what you should risk in any trade. So that is kind of the essence of risk management. Then you get behind all these traders and what they're doing. It all comes down to almost always to not risking too much on any given trade.
Right. That's key.
I mean, there are other elements.
Yeah.
There's diversification, and there's stopping the trading when you're starting to perform poorly. There's other elements. I don't mean to oversimplify it, but the
Right.
most important element is not to let yourself lose too much on any single trade.
For sure. And anybody watching, write that down, what Jack just said, for sure. And Jack, I thought, I just thought of this question. I think it's a really good one. It is, what historical trader during any time in history would you love to sit down with and interview if you got the chance?
Well, I mean, the person I've never interviewed that was always kind of on the top of my list, and it was not for not trying, was George Soros.
Mm-hmm.
So, no question, if I was going to interview anybody, Soros would be the trader that I would most have liked to interview. For a number of reasons. I mean, as far as discretionary trading, he's no doubt. I mean, if he's not the best of modern times, he's got to be in the top 5 or whatever,
Yeah.
But he may be the best. And there's so many insights he's had, and just remarkable trading stories and trading talent. Plus, he has an interesting background.
Yeah.
Besides trading, having escaped from, as a child from World War II, as a Jewish child,
Yeah.
and then trying to convert the communist world after the wall came down to capitalism, and that didn't quite work out. But he made that effort, and the experiences there. There's a lot of elements of it. So he's kind of a person I think whose life story and his insights about trading would have been great. But I never spoke to George. I never
Mm-hmm.
got past his coterie of people. And I even interviewed Druckenmiller, who ran Soros's funds during the time he was, in Eastern Europe and Soviet Union, ex-Soviet Union, Russia, trying to influence those countries towards democracy and capitalism. And Druckenmiller, of course, is a great trader in his own right. But and Druckenmiller I had him ask, but even that didn't help. So I just, whatever reason, I couldn't get Soros to agree to an interview. So that's the answer.
For sure. And what is your favorite interview that you've done over the course of all these years?
Oh, that's hard. I would say one hint to it. My favorite is typically is look at the first chapter, but it's not always.
Yeah.
But so Michael Marcus in Market Wizards is one of my favorites because he was so open and honest, and he had such interesting stories and a lot of good trading advice.
Yeah.
It's also one of the longest interviews. One of my other favorites was Ed Thorpe in
Mm-hmm.
Hedge Fund Market Wizards, because again, incredible range of stories, including his whole experiences with beating the casinos at their own game, which sounds impossible until when you read how he did it. Essentially, he did it with physics, not not that you're trying to come up with a number like a betting system based on the history of, say, roulette rolls or something like that, is kind of a fool's game. But no, he kind of used Newtonian physics to do it, So, but from those stories and the attempts on his life, for beating the casinos to all the hedge fund strategies he developed, to just a long life. And so that was one, and that's the longest chapter, I think, in any Market Wizards book. So that's certainly one of my favorites.
Mm-hmm.
Bill Lipschitz, I talked about the first chapter in New Market Wizards. I think just had some incredible stories and insights as well. So there's quite a number. I don't mean to rule out any others, but these are just some of the ones that come up. And I tend to like ones that not only have trading lessons, but actually have just compelling narratives that
Right.
would almost read almost read as like fiction, so.
Right, right. And what are some of the biggest takeaways that somebody reading your book that you want them to walk away with after reading any of your Market Wizards books?
Well, I think if people read it, they should come away with an understanding that the books are probably more about psychology than about trading.
Right.
That almost every trader gives greater weight to risk management than the methodology they're using. That you can't, if you're looking for somebody to give you a trading methodology on a silver trade, you haven't gotten to the point of even asking the right question, because you'll see repeatedly that people use their own approaches, even if doesn't mean you can't learn from other people, doesn't mean you can't be influenced. But if you try to copy their approaches, unless by some fluke your personality is perfectly aligned and skills are perfectly aligned with what that person's doing, it's not going to work because you're not them. So you can learn from other people, but you still have to make it your own approach. And so another very, very critical lesson that should come across is, hey, to succeed in this game, you've got to figure out what your own approach is, and it's not going to be obvious. You'll see a number of cases where people start with one thing and end up with another, and whatever you start out with may not be what works, may not be what you end up doing. But you have to be, and that leads to another thing, which is, I was going to say, you have to be flexible enough to change. That leads to the whole concept that the people that are good at trading, are flexible. They can admit they're wrong. They can admit that they made a mistake. In fact, I'll throw this out, and I'm now going to alienate 40% of your audience, if they're typical of the nation overall. I threw in one kind of like humorous line. I thought it was humorous. I put it as a joke, but I thought it made the point. And I don't get too many one-star reviews on any of my books. There, you go to any of the books and Amazon, you'll see they're almost all 5s or 4s, and occasionally you have a few 1s. But his last book, the same thing. I mean, it still has, I don't know if it's a 4.7 or whatever. It still has a very high rating, but you'll see a few 1s or criticisms. And they picked up, I had one line, and it's just amazingly. But I'm bringing this up because it leads to the thing of flexibility. Yeah. And I said, and I'm paraphrasing it, maybe it's exact, but it's pretty close. I said, I was trying to make the point that to be a good trader, you have to be able to admit you're wrong, to change your approach, to change your mind. And I said something like, politics aside, all I could say, if Trump was ever a trader, I am sure he would end up losing because he has never admitted he made a mistake. And so that pissed off. But I thought it was real. I can't think of a single time he said it. Well, if you like him or you hate him, I couldn't think of a single time where he's admitted he's wrong. No matter what, even if he's dead wrong, he'll never admit it. So I thought it was a fair analogy, and I thought it was a little humorous, but not if you're a Trump fan. Apparently, very, very thin-skinned. So, but I thought I was trying to make the point that you have to be able to admit you're wrong, and I believe if he ever traded, he would be a lousy trader because he doesn't have that flexibility. But anyway.
So to kind of say it another way, it's hard to be a really stellar trader if you let your ego kind of get in the way of decision making, basically. That's really it. You don't. So having an ego, in fact, that's where people go wrong. It's not of ego. I guess Schwartz, had years where he lost money. Then he goes on to this phenomenal, just mind-boggling performance, which at the time I had interviewed was like 10 years or so. I mean, you couldn't keep up that performance. It was a ridiculous rate of performance. I think it was like 25% average per month, some really crazy number. But he had a long phase there and he still continued to be successful, but just extraordinary performance. But I asked him, how did he go from winning to losing? And he said, I said, I became a winner when I understood it was okay to lose. And here's the key line. He said,
what is the rallying cry of a losing trader? I'll get out when I'm even. And why is that so important? Because if you can get back to even, you could say, I was not wrong. I did not make a mistake. And then need to protect the ego is exactly why people lose. So when you talk about that ego protection being a flaw, that's exactly it. I mean, that you're paraphrasing Schwartz's point, which when I give talks, I mean, I almost always include that because I think that's one of the most insightful things anybody has ever said in any of my interviews is why people lose. It's because they're trying to protect their ego, and that's a recipe for disaster.
Yeah, there's somebody I respect on Twitter who, in his Twitter bio, he's a great trader. He's a professional loss taker. I love how he put that there. You have to be willing to accept those small losses over and over again in exchange for that performance. You got to protect yourself from the big losses, which is what's going to set you back.
Yeah. But taking losses. I mean, a lot of number traders will say that my job is taking losses. I mean, it's
right.
But in a methodical way where it doesn't hurt your account. And almost all traders pay more attention to that. So, somebody like Peter Brandt, who is chapter 1 in this latest book, he talks about he's looking for points where, it's not that he'll think the market can have a significant move in a given direction when he puts on a trade. But what he's really looking at is where can he put on trades where he can put a meaningful stop that doesn't lose much money. His whole focus of what defines a good trade is where can I put on a trade that makes sense, that's not going to lose me much money when I'm wrong. That's his driving force. It's not how much can I make on the trade. It's where can I put a trade that has a reasonably good shot of return where I'm not going to lose much. It's still not losing much that drives his trades.
100%. Yeah, that's wonderfully put. And I want to ask you, outside of your books, which of course I really enjoy and are excellent, what is kind of a list of trading books that you think would be great for newer traders to pick up and do you think would really help out their trading journeys?
Yeah, well, one book that a lot of your ones may be familiar with, which influenced me, actually was an inspiration when I wrote the first Market Wizards book, because that was kind of my mental image of, hey, I'd like to be able to replicate that, is Reminiscences of a Stock Operator, which was a book written back in the 1920s. And even though it's talking about an era, where we had bucket shops and things are completely arcane, are obsolete, now. But so many of the comments, the protagonist. It's not by Jesse Livermore, but
Edwin Lefebvre.
The protagonist is clearly a fictionalized Jesse Livermore.
Right.
But so many of the things that he says sort of resonated with me when I was reading the book 65 years later. It's now 100 years later, but and it would still make sense. And so I think when I talk about going back to my own Market Wizards book, where I read it 25 years later, it's still what I was shooting for was to get these truths about trading and markets that sort of don't change no matter how much markets change. And so that's kind of a classic book, which is still relevant today, even though the markets bear no resemblance to what they did then. I mentioned, Brandt, by the way, we talked about Brandt. He wrote a book where I think died as a professional commodity trader, where he took a year of his trades and sort of died, just in real time, and why he took them and how he managed the risk. And that's kind of, if you're a chart trader, that's kind of a good book because it shows you how to mesh chart trading with risk management. Basically, I don't read, I actually don't read trading books. It's probably the last because, it's not something it's just not what I go to read. I may read about books about markets, but they're books which are more kind of, they're not about how to trade. They're books like When Genius Failed, a book I recommend, When Genius Failed, by Lowenstein, which is a great in-depth narrative on the LTCM thing. There's one of my favorite writers, I think books like The Big Short, and his first book, the Lawyer's Poker. So, you know, so those, those are not how to trade books by any means, but they're great stories. They're great fact-based stories about markets, and
Right.
so those are the types of books that I like. So it's not, for people looking at, hey, how to become a better trader. Those are not the type of books that are going to do it for you, but that's the kind of things I gravitate. If you go on to Quora and look up, I don't contribute, haven't contributed for a while, but at one point I was making contributions, and then somebody asked the question of one of my favorite books, and I did list a number of books there. So if people want to get that list, go on to Quora, put my name in, and one of the questions that I answered was a reading list.
And just specifically, we've talked so much about how important mindset and psychology is. Is there a mindset book that you think is really helpful? It doesn't have to be market related, but something like, I really enjoyed Atomic Habits by James Clear. That's one I really enjoyed. But love to hear your perspective.
Oh yeah, so I'm sure there are lots of good books like that. I haven't read that. I haven't read that group of books,
right?
To be able to recommend any I can think offhand. So there are lots of books out there, but I haven't read them. I can't make a recommendation there.
No problem. And going back to reminiscence of a stock operator, Jesse Livermore would have been a fantastic interview. That would have been really something, wouldn't it? I mean,
I suppose, yeah. I don't know if Edwin Lefebvre interviewed Jesse Livermore.
Yeah.
But I don't know how else he must, I never saw any references to him having interviewed him, but I don't know how else he could have written about it.
Right.
Because so many things are basically thoughts. So that, it was very hard to find. I wrote 75 years after the book came out. I was asked to do, it then became like free publication, the rights sort of expire. And there was some publisher was doing a 75-year anniversary. They wanted me to, I wrote a preface. So I went, in fact, I remember going, this is pre-Google, but I remember going to the, library in, the 42nd Street branch in Manhattan, like the biggest library. And we go back, and I was digging up old microfiche and Times on it, whatever I could find. It was very hard to find. I found some information about Lefebvre, but I couldn't find much information about I didn't find any references to interviewing more, but I imagine he must have. I even spoke to his grandson, but it was just a limited amount of information that was available.
For sure. And I'm curious to hear about how you find market wizards. Of course, you've got your platform FundSeeder, which I love to hear more about. But yeah, what's kind of your process, especially for the most recent book, Unknown Market Wizards, to find these individuals?
There were multiple. There were several ways. There were actually 3 ways I found everybody in this latest book. So one, as you mentioned, was FundSeeder, which is a platform which is basically a trader platform. People can get free performance analytics and stuff like that. Our goal for doing that platform is to be able to find undiscovered trading talent, and so there's FundSeeder Technologies, which is the platform, and there's FundSeeder Investments, where the game plan was for FundSeeder Investments to use the database from the technology side developed to find traders to use for investment products. And in fact, the first FundSeeder fund is, if it doesn't, hopefully it doesn't get rescheduled, but as far as I know, the latest information was a shooting for a December 1 launch. So it's very close. So, but it's just now getting to that point. But anyway, that's FundSeeder. Anyway, so some of the traders came from FundSeeder. Some of the traders I just knew. So like somebody like Jeff Newman had contacted me before I ever decided to do the book, telling me about it was kind of one of those unbelievable emails, like I took a $5,000 account to 50 million. And,
Yeah.
your first response is, yeah, sure. But, I kind of know that sometimes these stories are true. And I never take these unless I can prove it. So at the time I wasn't planning to do the book. I said, well, look, I'm not planning a book, but just in case I ever do, I'll keep your email kind of this. I'll save your email. And if you can prove, the story, it certainly sounds like it. That I'd say, sure enough, when I got around, for reasons, I just decided to do the book less than a year later. And when I decided to do it, I got in touch with him. And he literally sent me every monthly statement, for all those years. So I knew him though because he'd contacted me. Somebody like Chris Camillo, who's a fascinating chapter in this book. Won't go into it, but let's just say here's a guy who doesn't use fundamental analysis, who doesn't use technical analysis.
Social media, right? Yeah.
Yep, social media. Literally came up with his own methodology, like incredible, and done extraordinarily well. Right. So somebody like him, he wanted to meet me for unrelated reasons. I said, he's in Texas. I said, you want to fly? I'm Boulder, Colorado. I said, although now in Winter Park, I've got two places. Anyway, I said, you want to fly out and, meet me? I'm happy to have lunch with you. So I kind of knew it, but he started talking about he told me some of his background. And hey, that sounds like it would be. So I knew some traders like that. And the third group of traders, what I did is, I don't have a large Twitter following. I think at the time it was maybe 50,000 or whatever. But I basically put out a couple of tweets saying, hey, I'm going to do a new Market Wizard book. If you think you are a market wizard or you know anybody who is, send me this. And I got hundreds and hundreds of recommendations. And out of that, a few of them led to the interviews in the book. So those were the sources.
Perfect. Any plans for another one, or
no? But to be fair, I never have plans for another one. So the first one, I didn't have plans, but it was such a big hit that I did end up doing one. I thought I might as well do another one. And I had the trouble, wasn't the trouble, but the fact was that I had a number of traders I didn't get to use.
Right.
Well, the first one, which I knew would be good interviews, and I also subsequently learned. So I knew I had material for a second one. And it was such a big hit that I think, well, okay, I'll do a second one. But I never intended to do, that's what I thought, but then I ended up doing, let's say about 8 years later, I ended up doing a third, and then 12 years later, I did a fourth. And then I guess about 8 years later, I did the fifth one. So, there's been like a cycle of not exactly 8, other than the first two, there's been a cycle of 8+ years. I don't intend to do another one, but, one never knows.
Right. And this is a little bit of a selfish question for myself, since I do interviews as well. But how do you decide what questions to ask each trader? Do you do a lot of research beforehand so you kind of know what to expect? Or is it all in the moment, as you said, just kind of going with the conversation?
Yeah, I do some research, not a lot of research. Where there's stuff available, I'll look at it to have some idea. But it's not a ton of research. By and large, it's what I said before, is that I will just have a conversation,
right?
And I'll listen to what they answer. I'll try to go off what they answer,
right?
And that's really the key. And willing to give it as much time as they're willing to give it.
Right.
Sometimes those extra hours don't lead to anything. Sometimes they lead to the best stuff. You never know.
Right. Perfect. And Jack, thank you so much for your time. I always like to kind of edit out with this last question. What advice do you have for new traders who maybe just got started in the last few years, who are trying to find a system, trying to become more disciplined and get to that level of performance and become consistently profitable?
Yeah. So if you're a new trader, basically, I think the first thing is kind of learn. You gotta. And that means like you read a lot of stuff. Whatever your source is, whether it's off the internet or it's books or whatever. And the idea there is not that everything you're going to read is going to be worthwhile. Some of it may well be misleading. I talk about in one of my books. I talk about the misleading, the well-chosen examples. You have to be kind of attuned to people who do that, but you can certainly get ideas. And the point is, you're just looking for ideas. Then you want to take things that resonate, that seem to make sense with you, that you feel comfortable with, and try watching markets and applying those, not with real money, but just seeing how those ideas seem to work, and try to develop a methodology. And I usually advise paper trading before people go to real money, even though it's not the real thing. But if you can't be successful with paper trading, you're certainly not going to be successful with real trading, with real money. And successful paper trading doesn't guarantee it, but unsuccessful paper trading certainly will save you money until you're not ready. Now, when you seem to have some sort of methodology that seems to work, then start with an amount of money you can lose. And what I basically say is, whatever amount, let's say you say, okay, I got $100,000 here. If I can lose it, my life doesn't change. I still have my day job. But don't bet the whole 100. Say to yourself, okay, I've got a methodology here, and if I'm right, I shouldn't really lose more than 25%, as an example.
Right.
So you make a promise to yourself. You say, okay, I'm going to use the 100,000. I can margin fully, whatever. But if at any point my equity goes down to 75, the market's telling me what I'm doing, it just ain't working. I'll blow out of everything, go back to the drawing boards, come back in a number of months and try it again. That means you get a second chance. Lots of people blow out in the beginning. So you don't want to shoot the whole lot at one time. It's like it's just common sense that you want to make sure you have chips to come back into the game. So that's what a lot of people do wrong, is they start too early, they bet too much, they risk too much, they don't allow for them to blow out. And I think if you pre-plan that you're well ahead of the game.
100%. I think that's well said. And like you said about risk management, less than 1% of total your portfolio size on any given position, that's a good rule of thumb, especially to start with. A lot of people take a lot of outside risk, especially starting out. Yeah. Jack, thank you so much for your time. It's really been an honor for me to get a chance to sit down with you and ask you questions. So thank you so much. I'll have your links to your Twitter, your recent books, which are highly recommended. That's a great way to kind of find a system that kind of vibes with you, is reading Market Wizards and just kind of choosing one trader who, that's kind of interesting what they're doing. So Jack, thank you so much for coming on once again.
Sure. Hey, thanks a lot. I enjoyed the conversation.
Awesome. And to everybody watching, I hope you enjoyed as well. Go ahead and leave a like down below and subscribe to the Traderline channel. And we'll see you guys in future videos. Thanks.
Okay. Thanks.
Welcome to the Traderline podcast. I'm your host, Richard Moglen. Each of these episodes will feature a top trader or investor, such as market wizards and U.S. investing champions. Make sure to listen carefully as they share their stories and techniques that have allowed them to master their particular styles. This podcast is sponsored by Traderline University. Click the link in the description to learn more about exclusive experiences, such as the Swing Trading Masterclass, where you can learn directly from Oliver Kell, the U.S. investing champion. In this masterclass, Oliver explains his method comprehensively and walks through specific examples of his traits. Also, be sure to check out the Leadership Blueprints course, which will level up your technical analysis abilities and teach you proprietary edges and techniques you can use to identify and manage true market leaders. And with that said, sit back, relax, and enjoy. Hello everyone, welcome back to the Traderline podcast. I'm your host, Richard Moglen, and joining me today is a very special guest, Mark Minervini, the author of Think and Trade Like a Champion and Trade Like a Stock Market Wizard. And obviously, he's a former U.S. investing champion and currently leads this year with a return of 277% in the Money Manager division. Mark, it's a treat to have you on. Thanks so much for being here.
Thanks for having me. And don't forget about Mindset Seekers for Winning, because that's one of the most important books.
100%. And we're going to touch on mindset for sure today. But to start things off, I think we'll focus a little bit on the U.S. Investing Championship this year and kind of how you've traded in 2021. And at the end, we'll go through some charts. You've going to talk about a little bit of what you've traded today and recently, talking about both winners and losers. But to start things off, tell me a little bit about your decision to join the championship this year and the overall experience.
Sure. So, of course, I last time I was in the U.S. Investing Championship was, I think, 24 or 25 years ago, which was 1997, and I won it. And it was a great experience. The reason why I joined it again was I just wanted to show that these techniques that I use are timeless. Right. And again, when I first joined it, I had everybody told me, why you shouldn't, don't do it. It's all risk. If you don't win, you're going to look bad. So, I mean, I just figured, I said, if I don't win, I felt like I, certainly could win, but I said, if I don't win, I'm certainly not going to embarrass myself. I'm going to have a good performance. So that's why I joined it this year.
And it's been an interesting year for breakout styles of trading. A lot of kind of choppy markets, a lot of breakouts failing. So how have you kind of adapted your style to basically match the environment? Because it's completely different than 2020, where everything followed through just because the market was so strong. But this year, it's been a little bit of a different environment.
Yeah, well, some people think that I changed my style. I changed my strategy, which is nothing can be further from the truth. The only thing I did was I just assessed what I was getting on the upside, and then decided to trade on a shorter time frame and take less reward, and then just tightened up my stop in relation to that. So I'm always trying to figure out what type of reward I'm getting and if it's paying for my risk. So if my normal, say stop loss is, I average, let's say 5 or 6%, my max stop is say 8 or 10. Well, if I'm not getting the reward, if I'm not getting the gains, then something's got to change. And I can't control the upside, but I can control the downside, and I can control where I sell. So the adjustment that I made was that I just said, I'm going to take quicker profits and I'm going to take smaller losses. And that allowed me to compound very rapidly. And for that style, the market has been fantastic ever since February.
For sure. And getting a little bit into the mindset, because obviously competing in the U.S. Investing Championship and getting returns publicized, that does have some added pressure. So what are some tips you have for traders to deal with trading, taking losses, all of that? And of course, you've written an entire book on this, The Mindset Secrets for Winning. But yeah, could you talk a little bit about that?
Well, when we talk about mindset, really to boil it down for trading, the main mindset that I have is preparation. So everything that I do is to prepare for every eventuality. So it's all about, planning. And when you first start doing this, of course, you don't have maybe your strategy down. You don't have the expertise. So you study, you read books, you'll go to workshops, you make a plan, and then you trade. And then from there, after you evaluate and you see what happened, what went wrong, what went right, and then you study some more, replan, and do it all over again. So that's sort of the cycle. The main thing is that mindset has to be where you really have to make sure that you're constantly preparing and studying what happened, what went wrong, what went good, and doing that post analysis. And this is something that very few people do or do for any length of time. Even those that do it, they may do it for a little while, but it's not something that they have in their routine for a long through their trading career. I mean, I've been doing this for this year will be my 38th year trading, and I'm still evaluating and doing post analysis and keeping in touch with my numbers and making sure that I know the truth about my trading at all times. So that, again, we can get very deep into mindset, but the main thing is to always, be preparing.
And to dive into that a little bit, I want to talk about both your weekend and daily routines. So starting with the weekend routine, what do you do to analyze the market, your current stocks, the market leadership, the breadth of the market, to make sure you're prepared for the next week, and also identify those best opportunities for your particular style?
Yeah, believe it or not, I do very little work on the general market. I don't really do a whole lot of general market analysis. I mean, I look at the price and volume of the market. I look at the major indexes. I do have some, readings or indicators that I follow, some sentiment, but I'm really doing the majority of my work is 90% of it is all stock work. So if there's a lot of stocks, then I'm bullish on the market. If there's not a lot of stocks, I'm bearish on the market, or I'm at least careful I can't buy anything if I don't have the stocks, if the stocks aren't set up. And if the stocks aren't working, if there are a lot of stock setups and they're not working, then I really know, the market's not a great market. So my routine is really just screening for stocks and trying to find out, as much as I can about those stocks. And most of them I already know, like there's only so many names. So as I'm screening, if Netflix, Google, Goldman Sachs, for instance, broke out today, yeah, I know these companies well already. Now there might be some smaller company that I never heard of, so then I try to get up to speed on that and take a look at the fundamentals, and from there I'm just creating a list. I basically create 3 lists. I have my buy alert list. Oh, sorry about that.
No problem.
Shut my phone off. I have my buy alert list. I have my high on deck, and I have my watch list. So basically, watch are stocks that are the candidates, but they're not very close. High on deck, they're very close, and buy alert are in position to be bought. Then when that next trading day comes, I've already made the decision as which stocks are ready to be bought, and I've already decided what price I'm buying, and I've already decided my stop loss, and all that's figured out ahead of time. So then when the trading day comes, I just put in my alerts, and when those alerts go off, I start buying stocks and selling stocks.
Perfect. And what are those fundamentals that you particularly care about when it comes to screening or just when you want to look up a stock?
Right. So when you're dealing with growth stocks, there's a handful of ways that I slice and dice fundamentals. However, I'm really only looking at 3 things. Pretty much, 90% of what I'm doing is focused on earnings, sales, and margins. And that if you get really good at deciphering those 3 things. Right. And like I said, there's a bunch of different ways to slice and dice those. In my first book, Trade Like a Stock Market Wizard, there's a whole section on, it's called Fundamentals to Focus On, and it gives you some ways to look at those numbers, breakout years and acceleration and various things to look at, margins. But those, it's really focused on those three fundamentals. That's really, when it comes down to a business, it's all about how much, revenues, profit margins, and turning it into earnings. And that's the engine behind a growth stock.
Gotcha. And now moving on to kind of your daily routine, you've got your 3 lists set up for the week. How many stocks on average would you say are on that buy alert list? Because I found personally, it's a lot easier to execute well on a very small select number than try to manage 15, 20 names even in that morning when the bell rings.
Well, that happens to be, I think, one of the mistakes that some newbies make is where they just want to have everything on the list, and they just they don't narrow it down, and that's just because they don't really have their selection criteria really fine-tuned, and they're not looking for the very best of setups. So I'm really looking for those aces and kings and queens. I'm looking for the premium hands, just like with poker. You want to play premium hands. I want to play premium hands in the market. So I'm looking for the best technical setups. But to answer your question, there could be 40, 50, or 60 names in a really great environment, or there could be no names or just a couple. So it's all based on and it's a function of the market environment and whether, how healthy the market is at any given point. But generally, it'll be anywhere between just a small handful and as much as 40 or 50 names.
Gotcha. And walk me through kind of from the moment you wake up, your daily routine to prepare yourself for that open, because I know you do a lot of visualization and breathing exercises to help you kind of stay focused and get you ready to execute at the highest ability that you're capable of.
Yeah, I don't do it every day, but a lot of days I will go down to the beach and I'll meditate on the beach if I have the time and if I got a good night's sleep and I wake up early enough. And I like to do something like that first, to sort of be in a nice calmed state in a natural environment. So that's really great to do to get yourself in balanced, if you will. But I do visualization every single day, and morning and night. I pretty much, it's just become an automatic habit that I do. And I also do breathing exercises, which my wife was doing a lot of, not Wim Hof, but a lot of really sophisticated breathing techniques. She had some friends that they would regularly do it on a daily basis, and I started learning from them some more sophisticated techniques. But I use a very basic box breathing technique that Navy SEALs use when they're under pressure. And so I do that in the morning. I do my breathing. It's only 5 minutes of breathing, and then I do a mental rehearsal. Especially I'll flip on the TV real quick and just check and see if the Dow's down 800 points, or if it's it's up big. And then from there, that'll sort of like let me know what I need to prepare for. If all of a sudden there's the market's down huge, I know that I'm going to be going into gaps down and probably some stops being hit. So I start to think, to play through my mind how I'm going to handle that. And just the opposite, if things are, moving up, and the market's up huge, I might have some gaps that you have. The last few days have been a good example, and even today, where some stocks, or yesterday was a good example, where some stocks that were on my list actually gapped out. There were small gaps, but I don't chase gaps. So I want to make sure that I'm disciplined. And if the stock doesn't meet my criteria, if it gets away from my buy point, I'm going to leave it alone. So I start going through that and visualizing, what could happen. And I already know the names on my list. I already know what I'm interested in. So as those stocks are moving, I'm prepared. Again, it's all about preparation. So this is another part of the preparation that not only am I doing all the work, but I'm also doing the mental preparation to then intersect with that work.
Perfect. And getting a little bit back to your trading style, obviously you're up 277% this year. That's kind of unthinkable for many people. What are some keys to achieving returns, triple-digit returns and greater, that you think most people have misunderstandings about, or you think would help out new traders?
Well, you're definitely not going to get those big returns by having a well-diversified portfolio and low turnover and all the things that you might be told from a financial advisor. So this isn't something, they don't try this at home, kids, that kind of thing. So I'm using leverage, and I'm taking at times very, very large positions. But I'm still managing the risk, just as stringent as I would otherwise, but I am really gassing it quite a bit this year to get that. And there's tremendous amounts of turnover. So you need turnover, you need concentration, you need concentrated positions, you need timing too, because you can't, you're going to have to avoid dead time. You have 1 year to lay down this return, and you're going against a whole bunch of people where some people may just get lucky. They stick it in one name and take a big position, and so you're going against not only skilled traders, but you're going against a large group where someone along the line is going to get lucky. So there's going to be some, usually going to be some big returns. So you've got to get a pretty big return to, going back, you look at these contests. The good thing is this is a real money contest. And in my division, it's $1 million. So you're not going to get, somebody's not going to go, a professional's not going to go and stick $1 million in a penny stock probably to win the U.S. investing championship when there's not even a cash prize. So that's the good part about a real money contest. And the only contest that I would ever go in would be a real money contest. The $20,000 division, people might get a little crazier there. If I was in the $20,000 division, I certainly would be taking even more risks, because that would be an amount of money that if I had trouble with, that I could recover from. So I don't even remember your original question, but what I've been doing, with the U.S. Investing Championship is just, is very aggressive. Probably the second most aggressive that I've ever traded. Going back, probably the most aggressive I've ever traded was probably in 1995, where I was up over 400%. And then for the 97 U.S. Investing Championship, I was pretty darn aggressive then too. And that year I was up 155%.
Right. And I always find it interesting. How do you personally define risk? And also, what kind of total open risk on your portfolio have you been taking on this year?
Well, open risk, I'm not sure what you mean by open risk. I mean, are you talking about
if everything got stopped down your portio, that type of
everything
thing?
went against me at one time. Yeah. Okay. So total risk. Well, that would be, I would say that the risk would be high when if I go into these leveraged positions, I start buying on leverage. But I'm watching these things all day. So if they started to move against me, I would be paring back pretty quickly. If I'm on leverage and I'm have these huge positions, I'm not I'm not taking any big risk as far as letting them stop me out like I normally would on a normal size position. I might have a,
Right.
4, 5, 6, 8% stop on a regular sized position. But if I'm in and I'm 4x leverage in a stock, if that thing doesn't go intraday and get me at a gain right away, I'm out.
Right.
So to answer your question though, a full, drawdown, it's the same thing as it's the same as individual positions. So if my max stop on an individual stock is 8%, well, then my max drawdown would be 8% from principal. Now, from a peak, now that could change, because now if you were up, say 30% and you said, well, I'm going to put, I'm going to backstop, up 10. Well, now you've got you've given up 20%. Or if you go all the way back to break even, you'd give all that back. I don't allow stocks to go down like that. I mean, once I'm up, I'm nailing that profit down. I'm very good at maintaining my profits and protecting them. Because of that, there's a trade-off though. Because of that, I very seldom hold for a big move, because now I'm going to get clipped out on a pullback. So that's you can't have your cake and eat it too. If you're going to short-term trade, you're going to give up the bigger move. If you're going to go for the bigger move, well, then you're going to give up the short-term. You're going to give up some short-term gains because you got to go through pullbacks. So you have to sacrifice. So in my experience, going for the shorter moves, you have more control over, and then you can roll that over and get the compounding.
And this year, do you have a sense of what your average gain is, your average loss, and also your batting average?
Well, I guess not exactly. I mean, my batting average is always about the same. It ranges anywhere between 35% and 65%. When things are going really good, it's above 50. When they're going bad, it's below. I mean, to tell you the truth, like, my assistant Bob asked me, he's like, what are you up, for the year now? And I'm like, I have no idea. I'm basically just sort of, they say kicking ass and taking names. Half the time, a lot of people would never believe this, but a lot of time I don't even know what the market did. I don't even know what the Dow did at the end of the day. I got to look and see. I'm just trading. I'm trading the setups. I'm totally in process. I do the post analysis afterwards. But again, also I think, the number is going to be definitely skewed because, all right, for instance, I take this big giant position, and if that stock doesn't go up right away, I'm out. So it's this little tiny loss, or maybe even a little tiny gain. But then, I'm holding a regular size position for a bigger move, and that might be, that profit might be 10, 12, whatever, 15%, 17%, and the losses will be bigger. But there's so much jockeying for position, and there's so much trading that it's definitely compressed everything, way down. But exact number, I don't have an exact number right this second.
Gotcha. And talking about this very aggressive style of trading, are you doing reverse pyramiding, meaning maybe you go in with 40% of your total portfolio size, and then as soon as it starts working for you, you're kind of taking some off as it works, or are you kind of building a position into a breakout or that type of thing?
So how I trade is I normally start small, and then I build up, and then I go back small as the stock becomes profitable. So if that's what you call reverse pyramiding, I always use progressive exposure. I never just dive into the market until I get some traction. I'm putting in test positions. As soon as those test positions start working, I ramp up really fast. And this is the difference between a pro and an amateur. An amateur is going to probably need a lot more evidence, and by the time they get the green lights, it might be a little late. And that's why progressive exposure, a lot of people say, oh, well, I tried it. By the time I ramp up, then everything pulls back, and then I pull back. Well, that's because you're not moving fast enough. You're not seeing what you need to see and reacting quickly. I've been doing this so long that I know, when I see the whites of the eyes, I know when to shoot. So I move up very quickly. Now, as I start, these stocks start going up, then I start scaling out into the strength. And that's a big part of not having drawdowns, is selling into the strength, because what you're doing is you're always at equity peak. So the stock may keep going higher, but you sold at the highest price. So even if it comes down, you're out, right? So there's no downside. There's no downside give back, and there's no upside maybe either, but you're at that point, you're at equity peak. So if you sell into strength, you're always selling at the highest price, so there is no drawdown. It cuts off the volatility. Now, the other thing too, I might add, and this is really important, I'm always angling, and because big performance is one thing, but what I'm really I think good at and what I'm proud of is the fact of the low drawdowns. And because most people who get the big performance have the volatility too. So what I do is at all times, I'm always thinking and trying, my aim is always to improve my worst case scenario. That sentence literally is a multi-million-dollar sentence. If you just think about that, always improve your worst case scenario. So let me give you an example. So I buy a stock, it starts moving up. Okay, so now the first thing I want to do is I want to protect my break-even point. I want to finance my risk. So as that stock moves up, I can move my stop to break even. Now I just improved my worst case scenario. Prior to that, I had a stop, let's say at 5%. So my worst case scenario was a 5% drawdown, right? So now I've improved my worst case scenario, but I can even make it even better. Let's say the stock goes up 8%. I have an 8% stop. I sell half of it. I can now allow that stock to come all the way down and hit my original stop and give it the room that I wanted to give it originally, but break even. So I've improved my worst case scenario, and I've given myself a chance also to participate in a bigger move, of course, with only half the gain, or I can move my stop to break even, sell half. Let's just say it's up, 16%. I sell half, and now if it stops me out at break even, I guarantee myself an 8% profit. So always looking to improve my worst case scenario, and by going in with that mindset, you start achieving a lot less volatility, because your goal is not the upside. Your goal is to limit the downside.
Right. And this year, are you even quicker to move your stop to break even to make sure you're limiting those drawdowns as much as possible?
Yeah, well, certainly, again, with the big positions, I'm sometimes going in with a microscopic stop and trying to get the timing absolutely perfect. If that stock doesn't move right on cue, I'll have a time stop, or I might have a very, very tight stop, not even the low of the day. It might just be, a lot of times I just go in and I just say, I only want to risk X amount on this. Okay, whether it's, you can call it $1,000, $10,000, whatever the number is. I've already determined this is the amount that I'm willing to risk on this, and then that's where the stop is.
And I wanted to ask you this about, in terms of stock selection this year, are you more focused on kind of the lower float names, which are going to be a little bit more volatile, but can make those really quick moves? Or are you sticking with kind of the larger float, more institutional quality type stocks?
I trade whatever sets up. So, and I trade accordingly. So if a very thin stock sets up, I may trade it, but I'm not going to have a big position in it. So I'm not going to be able to, just because of liquidity. So I'm trading whatever sets up, whatever meets the criteria. That's what I'm going to trade. See, that with that methodology, you allow the market to tell you where to put your money. So if, let's just say I was to say I'm only going to trade mega caps, and then all of a sudden there's this big bull market in small caps, well, I'd miss it, right? So my way, letting the market tell me where to go, I'm going to be where the action is regardless, because I'm not having any predetermined bias, and I'm not prejudiced for any. And again, if it's really thin, then I can't trade a big size in it. I'm just going to have, sometimes, there's a really thin stock. It trades 40,000 shares a day. I buy 1,000 shares. That would be a very, very tiny, insignificant position for me. And then you get something like, a Goldman Sachs, and, I'll buy $8 or $10 million in it.
Perfect. And so you said it actually brought some charts that you wanted to go over. Feel free to share your screen, and I'd love to just talk through what you were looking for, what was the pivot that you chose, and how you execute the position.
Sure, we can go over some charts. Schwab. So this is a recent purchase. You can see it's a really good large base here, tightened up nice on the right side here. So I was looking at it right here on 10/11, but it only had just a couple of days. I was hoping it tightened up a bit more. It looked like I might have missed it. Intraday, it started breaking out. I was like, okay, missed this one. It's probably just going to go. But no, it came back in, it squatted, then it had a little shakeout day, and then it came back. And you can, some of these things you can read about in my book. Some of this vernacular is mine. You're not going to hear it anywhere else, but reversal recoveries, squats, all these different things. So this had a 1, 2, This is a 1, 2, 3, a fourth day reversal recovery. And very often I'll buy a stock that's in a pivot if it also takes out a squat high, which I call a reversal recovery. And that was where we entered this stock right here. And this, again, this is made 1, 2, 3, 4, 6 or 7 days. Most of these stocks that have been breaking out lately, I mean, you get some that have worked, but it's like I've been calling them the pop and drop theme. They'll go up 1, 3, maybe if you're lucky, 5 to 7 days, and then that's it. Then they come all the way back down and they reverse and they take all the gain away. So, this has been, just trading, overweight positions intraday, and then, smaller positions, for the swing move. Let's see what else.
Could I actually ask you about this one, Mark?
Sure.
So here we've got a gap up as it's making its way through that squat reversal pivot. Can you talk about where you specifically entered on that day and when and what you were looking for on that day before you executed?
I can't remember exactly, but I'm pretty sure this was bought immediately as it started moving up in the morning. So on the gap, but you see the gap is so microscopic. It's not, if you were to measure the gap, it's not even above the high. So it's not like it's extended. You wouldn't say that this is, 2 or 3 or 4% above the pivot. It actually is right at the pivot. So I can't remember if I bought it right on the gap or I think I bought it as it went through the 78.94. I have to look. Let me see if I actually have. Okay, so 79.45 was the buy price. So it is as it went through this level. 79.45. So I got about, it looks like maybe a 45 cents of slippage.
Gotcha. And as you're looking to execute and watching this, what time are you only looking at the daily time frame, or do you also kind of nail down on lower time frames just to see how it's acting intraday?
No, I do have a 5-minute up on I have a separate screen that has where I enter my orders, and it has a daily, weekly, and 5-minute. So I'm aware of the 5-minute, but I do not trade off of intraday charts at all. Even if I'm doing a day trade, it's off of the daily chart, and I always look at a weekly too.
Gotcha.
Yeah.
And for this one, I don't know if you remember, but if you're buying pretty much right at the open, where's your initial stop loss on that, or are you just watching it intraday? And if it reverses, because sometimes these gap ups can just completely fade. So I want to know kind of how you're managing risk with this buy.
Well, if you're trading this from a swing trade, I have a different stop on day one than I might have on day 2 and on. So for instance, on the very first day, when this comes out here, just think about it. If this stock looked like this, okay, it breaks out and then, I don't know, end of the day, midday, it comes off and it looks like this, and it closes below, I'm sorry, it takes out this low. So now you would have an engulfing, right? And this is what I refer to as the megaphone effect. When you break out, now you've got this, right? So the volatility has widened, right? So that would be almost an automatic sell. I'd probably just reverse my position from a swing trading basis, even from a day trading basis. Now, if your upside is much less than your swing trades, you're probably going to have to use maybe the day's low or previous day's low or whatever, maybe just a mathematical stop. But from a swing trading basis, now if you measure that from here, what did I say? 49 cents, right? 79.45. We'll get it pretty close there. Down here, that's about 6%, 5.5 to 6%. So that's about normal. That should be enough room. That should be enough room. If you have to give a stock more than 5 to 8%, well, then your timing of the trade is not very precise, and you're not coming from these tight DCP entry points. So again, I'm using the stop. The risk is actually a selection tool. Now, I'm not going to go into a stock that's all over the place, because then it could just be acting normal, but it's going to knock me out because it's a bucking bronco. So I'm not riding those bucking broncos.
Right.
Want to see a couple more?
Yeah, go for it.
So PayPal is another one. So this is right here. Bought it right here. And so you can see again, this tried to break out and then it squatted. But then the next day, it just undercut the low, ended up closing up. So this is where we sold it, right here, here, and then sold some here. And then recently we actually bought this back over here. It's not drawn in, but I think it was right here. I think it was on the 7th.
And
then
there's the
just
bearish
got,
engulfing. Yeah.
yeah, and there's the bearish engulfing. See right there, boom. That's not a very good sign right there. And if I'm going to hold, I'm certainly, if it starts falling down from there, I'm going to definitely get out. So that's not a good sign there. So another one, and I remember, if you remember, I was talking about the steel stocks on Twitter. I really thought these were going to have a much bigger run, but they didn't. They just had a short spurt here, but bought it right here. Coming out of this little pivot right here. And it was nice because it ran up real fast. You got 1, 2, 3, 4. You see 1, 2, 3, 4, 5 days. Just like I said, you're getting that 1, 2, 3 days, sometimes 4, 5, 6, 7 days of pop. And then what would normally happen in a really good market, if this was coming off of a bear market, correction, and these were the first stocks to be breaking out, you'd want to hold to this first pullback, and you maybe even, several pullbacks and play this for a bigger move. In this market, you want to sell right into this, and you see it has a little reaction here, but then it just fades, and they can't hold. So these are the winners too. These are some winning stocks. Here's PAG. So was actually buying it right here. And this wasn't enough to stop me out here. So, and then it reset, and this really got really nice right here and just took right off. So this is another stock that's set up really. If you take a look at the base here, this is really picture perfect.
That's textbook right there. Yeah.
Yeah, it's really textbook. Really just big cup with handle. I mean, perfect setup here. Still holding up pretty good here. Another one was SKY.
Did you add more on that second reset there?
No, I did not. But it certainly you could have. I think on the platform we advised that we said if you bought a smaller position, you should add to it here. If you hadn't bought a position, you should initiate here. I'll go back to that just so you know what we're talking about. Yeah. So again, what people have to understand is that at this point right here, that's all I saw. So this looked good enough to buy. It did look a little bit short. It would have been nice if it was a little bit longer on the right side, but it looked fine. But then as it goes through here, now it got even better. Now you really have a fully, developed right side. So again, if you had not bought it here, or maybe you had a tight stop and you got knocked out on this little pullback, right? You got 1, 2, 3, you got 4 lower lows, and which is a violation in my book. But again, I always look to the 3rd and 4th lower low and see if there's support. You got support on the 4th lower low, and it turned right back up. So if it doesn't hit my stop, that's not enough violation to stop out. So now over here, you can add to the position, or you can even initiate an initial position if you haven't bought it yet. Sorry about that.
And, no worries. And Mark, can I ask a question?
Yep, sure.
So do you have kind of a mental checklist that you go through before you execute a position? For instance, do you wait for volume to come in? What are you looking for right before you go ahead and put in the buy order?
No, because you see the volume, I'm going to look and see if the stock, a lot of times I'm watching it very carefully, and as it starts to go, that's where I start hopping on it. So I'm waiting to see if the stock starts to go. So that would be sort of the watch intraday, watching it. And I'm aware, I see it as it starts to move. I'll set an alert. An alert will go off, and then I can't. If it's 9:45 in the morning, you're not going to have the volume. The chances that you're going to have big volume at 9:45 in the morning or 10 o'clock in the morning, but you could extrapolate the volume and see how it's running. So you're at 10:30 and you've already got, let's say 1/3 of the daily volume. That's a good run rate. So I'm looking at the price. I'm just looking at the price. When the price gets through the level, and then I'm watching very carefully the subsequent action, seeing how if it holds up. A perfect example was today. I'll show you a stock today. Bought CFLT today. So this stock first came out, and then it did what I call an early day reversal. So it started coming out, and then it squatted, but it was still early in the day. I mean, we can have you look at this is a 5-minute here. Right, let's see here. So you see here, it comes out in the morning, and then it pulls back right away. And then it just goes through, it sits all day, but we ended up having a strong close here. So that's good. That's good. So that's fine. That's acting perfectly fine. So I'm watching it to see how it acts intraday, that breakout day. Now we look down and we see, okay, the volume was a little bit above average. Okay, that's good. You had a good close. Now these subsequent days, and this is something, if you go to my book, Think and Trade Like a Champion, I show the exact things to look for, that I look for, what you want to look for, what I call confirmations or violations. Is the stock telling you, hey, this is the train's coming in on schedule, this is acting normal, sit with it and hold it for a bigger move because everything's going as scheduled, or this is concerning, or starting to see abnormal action. And that's what you want to look at, those first 3, 5, 7, 10 days, and ascertain whether the stock is acting right from day one into the first week or two. And that's going to let you know whether the stock, whether you should be holding it, adding to it, reducing it, and so forth.
And talking about that right side, how tight, basically in general percentages, do you want that right side, that pivot to form at? I think when you spoke earlier at Dr. Rish's class, you mentioned 10% is kind of your guideline, but what do you kind of use?
I'd like it to be single digits. I would like it to be in the single digits. Now the thing is, especially like on something like this, I have a friend that does some really good fundamental work and likes this company, and so it's set up technically, and so I cut this a little bit of slack here. I would have liked this to tighten up, but I know we're late stage right now. I know there's tons of retail eyes on all these stocks. If there's any kind of base, every Tom, Dick, and Harry is jumping on these stocks, and that's why they're coming out early. They're running up. A lot of them run up and fail because there's just not enough volume in there. It's retail volume. Institutions come in, then they sell right into it. So I'll try these, and if this doesn't work, I'm real tight on this. If this doesn't work and I don't get a good breakout and I don't get the follow through, well, then I'm just going to cut out. I'm going to get out of it. So you just got to be a little more vigilant. Again, I've been doing this for almost 4 decades, probably longer than most people watching this are alive, or certainly as long as they've been trading. So I've got a really good feel and a really, really good sensors, for when things are acting normal or not. But yeah, so you want to see a few that did not work out, or that had some violations? Show you a few. So Burlington, this came out of a perfect base, just real tight right here. You see, you got real tight. The volume came right in, so that's really great. That's setting up just right. Broke out. You had a nice breakout on that day. Look, the volume is well above average. Next day, you start to follow through, but then you reverse. So all this is okay. It's still acting fine. Even the pullback here is okay. But as you start counting the days now you get into day 5, 6, 7, right? So remember I said, watch the first, 3, 4, 5, 6 days up to the first 2 weeks. So we count the days. 1, we got 2 up days, 3, 4, 5, 6, only 2 out of 6 up days, right? You've got 1, 2, 3, 4 lower lows. And on that 4th lower low, it's a bad close. Volume is starting to come up. So now you got some violations. So this, if you have not hit your stop yet, this should definitely get your attention and say, wait a minute, this is not acting right. Now you try to rally back, and this will very often happen where you'll get that rally back and everything's okay, and then bang, then it comes in and you get that gap down. Maybe you go into earnings, or there's some surprise that comes out. So again, this is not acting right, and so you'd be reducing here, reducing or maybe even stopping out. So this is one, and then you see here, it's off, pretty substantially from that point. Another one is, let's see, ATVI, Activision, of course. So this one here, well, let me just make sure I get the right date here. 6/14, right? So that's right here. Yeah. Yep. So bought this coming out right here. And again, let's look at this base. So this is coming out. And again, if you take a look here, you draw a line right across here. It was really clearing most of the supply here. So that looks pretty good. You'd only had a short period of time that it traded above this level. You're pretty tight on the right side. Volume came down. So again, you could get it right. And it just doesn't mean that it's going to work. That's why you have to embrace stops, because half of these plays are not going to work. This is about probabilities, but right away. And what I want it to stop me out immediately. Like if it's going to stop me out, I want to know day 1, day 2, because then I can redeploy the money and move it into something else that's moving, or go into cash and protect myself if this is the start of a correction and it's starting to be picked up in my names. So I want to know right away because I want to avoid dead wood. I want to avoid, sitting, sometimes someone will get upset, oh, you got stopped out. They get stopped out right away. Well, would you rather have it go, stop you out 3 months later and you get the same loss, but then you lost 3 months of time? The time is very valuable. Time is money. You want to get compounding, to maximize compounding, you need to compress the time. So I want to know right away. This one, let me know right away. Breaks out next day, bang, right in. This has a couple violations. So see, it comes out here on volume. The next day, you've got a sell off, and the volume's larger.
Higher, yeah.
And then it goes larger the next day too. So that's what I call low volume out, high volume in. So the violations we have here are low volume out, high volume in, close below the 20, close below the 50. Sorry, 1, 2, 3. You got 4 lower lows. So if this hadn't already hit your stop, you should be gone, because there's just too many violations. This is completely abnormal. And then again, you see it tries to rally and then rolls over because this is under distribution. And that came off quite a bit here. Let's see what else. So ZLAB.
Yep.
ZLAB. This was setting up. I actually tried to buy this coming up from this pullback buy right here. So I tried to get a little head start on it, and right away it didn't act right. And again, you see right after you get the violations, you get the 4 or 5 lower lows. It closes on its low. You get no follow through. So this is just not acting right. And then it comes back. Like, oh, everything's okay. But see, then the real trouble starts happening. So that abnormal action was giving you that tip off. And then of course that sold off quite a bit. And then of course, what everybody knows, some people got very surprised with this was Snap. This one here, we were originally buying Snap way back here. This is where I was first buying Snap. And I sold it way too early. I sold it into here, which I believe was the earnings gap. Tried it a few more times. Over here, we actually got back into it, but we got stopped out right on this day right here, which was on 10/18, this outside day. And then a few more days, and then bingo, the big surprise that KO'd a lot of people on this stock. So that was one that we recently stopped out of. So, those are a few examples of stocks that worked and stocks that did not work. And like I said, the key is to pick those warning signs up and to keep that loss to a minimum. But the main thing is, I know everybody wants to know. They'll say, well, what's your average loss? What's your batting average? What's important is what your average gain is. That's what's important. The number that you're searching for is your personal average gain. Because let's just say it's 6%. Well, then and your batting average is, we'll just say 50%. Well, then you automatically know to be at a 2-to-1, you have to average 3% stops, right? It's a mathematical equation. Once you know that information and you know what your average gain is, you know how many times you're right versus you're losing, your batting average, percentage of winning trades, the loss side, the slider that you have control over. See, these other, think of them as different sliders. Some of them are automated. They're moving on their own, right? So, but you have control of these few moving parts: what you buy, when you buy, how much you buy, and when you sell. Those are the 4 things that you have complete 100% control over. You don't control how much the stock goes up. You don't control, anything other than those 4 things. So you can't rely upon that. All right. Your reliance has to be on the things that you control. Now, it's all about making assumptions. So what is your assumption based on? I mean, it's just pie in the sky. You just think the stock can go up X amount. That's not what I do. I look at my real results. What am I performing? How am I performing on the upside? And then I choose that stop based on a fraction of that result on the upside.
Gotcha.
If that makes sense.
No, absolutely. And I also wanted to touch on progressive exposure a little bit, Mark, because that's such an important concept. And I think reading your books really cemented that for me, the importance of it. So I don't know if you want to bring up a chart of just a general index and talk about how you've handled increasing exposure back after this recent market correction or pullback.
I can certainly do that. I know, again, though, I don't, I would not I would caution anybody to try to correlate and start looking at the indexes and make your trading be based on the indexes. It's just the opposite. I'm going to be basing my trading
stocks
on
first.
the stocks. Now, they might or might not correlate with good timing on the indexes. There's times where you'll get like, all right, look at this correction in the NASDAQ. Okay, so you come up this right side. You might think, oh, well, coming off these lows here, maybe this is where all the stocks started breaking out of bases. Maybe not. They might have just started today. Mm-hmm. I've seen times like 1995 was one of my biggest years. I was up over 400% that year. The market had already gone up for an extended period of time, and I didn't even start trading until April of 95. So, and we could probably go back and look at that. I could probably pull this chart back, but the market was already up. It was already up. And I didn't start getting the stock setups until the market looked like it was, had already made a pretty good move. So again, sometimes you're in before the market even makes a low. So the market's correcting. You're in a bear market. You have a thrust down, another thrust down. On your second thrust down, or your rally off the second thrust down off the lows, a bunch of stocks start breaking out of bases. You start buying some stocks. Now the market takes another downturn, makes a new low. The news is horrible. Well, we just hit new lows. The Dow's down 500. Meanwhile, the stocks that you bought that broke out are just pulling back to the breakout, perfectly natural. Right. You're in the leaders. That happened in 1990 going to 91. I bought a whole bunch of names, US Surgical, Amgen. These stocks were breaking out in around the lows around October. The market didn't really start taking off until January 15th. After it built this big giant cup with handle, we went to war in Iraq, and then bang, the market took off like a rocket. But the leaders were already coming out of bases months ahead of time. So again, focus on the stocks. I always say this: imagine if nobody ever invented an index. There's no such thing as an index. Could we still trade? Of course we could. Mm-hmm. We probably would trade much better. What would you focus on? You'd focus on individual stocks, right? You would follow individual stocks. And maybe you would create an index in your mind. You'd look at a whole bunch of, the semiconductor stocks are acting great. So that would be the same thing as having an index of them, but you're just doing it anecdotally by looking at the individual stocks. So, but now we've created all these indexes. So now all of a sudden, a basket of 30 stocks is called the market. How ridiculous is that? There's 10,000 stocks in the market, and we're going to call a basket of 30 stocks that are price weighted. They're price weighted. So only a small handful of them even account for most of the move on any one day. And there's only 30 of them. And suddenly that represents the 10,000 stocks. It's completely backwards. The 10,000 stocks are what's important. How is the broad market acting? And if you're going and looking at the waves coming in, and you're looking at one individual wave, well, the current, the current of the ocean, the direction of the ocean, whether if the tide's coming in or going out, and you're trying to look at these little waves coming in, but the whole tide's going out. Well, which is more important, right? The tide.
Right. Makes sense. But I just kind of wanted to hear generally how you increase exposure from this correction. How quickly?
I know. He's like, that's great, but I'd like you to answer the question.
No worries.
I do that all the time. You know that.
No. You made an excellent point.
I'm a ranter.
No, for sure.
Yeah. So you want to know how I increased the exposure?
Yeah.
Okay. So again, that has nothing to do with the indexes. That's where you threw me off a little bit.
Yeah, my fault on that.
I think what you're trying to say is look and correlate.
Exactly.
Yes. Okay. So, and again, like I said, it may correlate. It may not. It may correlate where I'm getting real aggressive off, coming off the lows, or it might be late. So how I do it is I'm just looking for stock setups. If I start seeing stocks setting up and they're meeting my criteria, I'm going to take a few small positions, some pilot buys. Normally that's going to be, if my normal size is, let's say 20, 25%, it'll be 5 or 10%. If those work, maybe I take 2 trades. If they work, I'll bump up to 15, 20%, or maybe I'll just bump up a few more positions and I'll go up to 25, 30%, invested. Normally my first 2 entries in the market are anywhere between 25 and 50% invested. And then if things are working, bang, I move real quick to 75 to 100. And again, it's just based on the individual stocks. And I know people always ask for a number. They're like, well, how many trades? How many have to be up? How much do they have to be up? Do they have to be closed profits or open profits? It depends. It depends. If I've got some open profits, let's just say, I bought 3 or 4 names and they're all up 6-8%, and that's looking great. And I see my buy list is just expanding. There's a whole bunch of names setting up and stocks breaking out. Well, that's really good. Like I'll increase my exposure from there. But let's say just the opposite. Okay, I got those same 4 stocks. They're up, but there's not many stocks on the buy list, and a lot of stocks are breaking out and they're failing. And I have got a couple names that are holding up, but I'm really just not seeing what I need to see for those follow-up names in that second wave or so. So that will be where I might wait a little longer and I might pause a bit. So there's just not really a set mechanical black box number. There is some feel in there.
Gotcha. Perfect, Mark. So to wrap things up, I thought I'd just kind of ask you one last question. What kind of general advice would you have for people or suggestions for what to study for traders who want to kind of match your returns and get to that level of super performance?
So, well, to match my returns, that's like, I think that's like saying, I mean, I don't want to sound, arrogant, but that's like saying, what do you have to do to start off playing basketball and play like a professional NBA player? It's going to take time. All right. It's
approach that level. Yeah.
Yeah. You're not going to I think this is one of the problems that people expect. They open up a stock account and they expect to be doing great, in a couple months. I mean, there's no business that you would ever think that you would ever have that expectation. Like you wouldn't go to college for 3 months or even a year and think that you could be a trial attorney or think that you could be a surgeon or you wouldn't even go, if you went to McDonald's, you wouldn't even know how to operate the fry later or know how to manage a McDonald's. It would take you months and months of training and probably years to work your way up to be an assistant manager. So stock trading is a lot harder than those professions. So, you got to put in the time. You have to put in the time. Now, I don't want to say you shouldn't have expectations of being great and having huge returns and winning the U.S. Investing Championship and being a smashing success. Everybody has that, potential because you're not born a great stock trader. You learn this. However, to get to that, you need to temper your expectations, because if you're expecting this soon, you're going to get disappointed and you're going to quit because you're just putting way too much pressure on yourself. So it's going to take time. Study. The main thing is to find a strategy that has an edge, that has been proven, that fits your personality and that you can believe in and commit to it. And the key is, Zig Ziglar said, the best sale that a salesman can make is to sell themselves. That before you can sell somebody else really well, you've got to believe in the product. So you've got to believe in what you're doing 100% and really, really sell yourself on it and do the work and know everything about it, be a specialist. Then you can be really great at it. You're not going to, just like sports, you're not going to be able to be a great hockey player, basketball player, a football player. You've got to put all your effort into one thing, become a specialist. And even when you get into that, you specialize in one area. You might be a center or a guard, or a quarterback or a running back. Again, it's all about specialization. The people that are great champions, they do one thing well. I mean, you got a few people, Bo Jackson and Deion Sanders, they were able to play baseball and football both well. But how many people are even able to do 2 sports? Let alone. So the trading is the same. You got to really, really concentrate and get good at one thing, commit to it, and think in terms of 5 to 10 years, not 5 to 10 months or a couple of years. Make a 10-year plan. Just imagine if you're 30 years old, 40 years old, if you could get this down in 5 or 10 years and change your life, that's a great goal.
100%. Well said. And Mark, I'll have a link to your Twitter down below. But what other resources and where else can people learn from you and learn your style? I know you've got the Master Trader program coming up very shortly.
Yeah, well, it's coming up next week, so there's only a short period of time to register for that. But that's where we go over this stuff, in depth from A to Z. You came to the Master Trader program, right?
Yeah, last year.
Yeah, so it's it's a giant undertaking to go through the Master Trader program. It's this year it's going to be a total of 7 days. So, and I don't know, 30 hours of curriculum plus a live trading day. So that's something that you can find at forstocktraders.com, or you can go to minervini.com and learn about it.
And for everybody watching who's interested, I would also highly recommend reading Mark's books multiple times before you attend, just so you really are coming prepared. So with that, Mark, I wanted to thank you so much for coming on, walking through the charts, talking over your style and process. We really appreciate you coming on, and yeah, thanks so much.
Okay, well, I hope it's been helpful.
Oh, for sure. And everybody watching, I hope you enjoyed as well. Leave a like down below and subscribe to the Traderline channel, and we'll see you guys in future videos. Thanks. Welcome to the Traderline podcast. I'm your host, Richard Moglen. Each of these episodes will feature a top trader or investor, such as market wizards and U.S. investing champions. Make sure to listen carefully as they share their stories and techniques that have allowed them to master their particular styles. This podcast is sponsored by Traderline University. Click the link in the description to learn more about exclusive experiences, such as the Swing Trading Masterclass, where you can learn directly from Oliver Kell, the U.S. investing champion. In his masterclass, Oliver explains his method comprehensively and walks through specific examples of his traits. Also, be sure to check out the Leadership Blueprints course, which will level up your technical analysis abilities and teach you proprietary edges and techniques you can use to identify and manage true market leaders. And with that said, sit back, relax, and enjoy. Hello everyone, welcome back to the Traderline podcast. I'm your host, Richard Moglen. Joining us today is a very special guest, David Ryan. David is an extremely experienced investor and trader and was profiled in Jack Schwager's Market Wizards, along with his mentor, William O'Neill. He also won the U.S. Investing Championship for 3 straight years in 1985, 86, and 87, with triple-digit returns each year. David, thank you so much for taking the time to speak with me today, and welcome. It's truly an honor.
Okay, thank you for having me on.
My pleasure. So to start things off, I always think it's really interesting to hear about people's backgrounds and how you first got interested in the stock market and maybe even purchased your first share of a stock. So yeah, could you tell us a little bit about your journey and where it all began?
Okay, well, it actually really began around the dinner table. And this is, this dates me, but back in the probably mid to late 60s, my dad would come home. He developed real estate, and we would sit around the dinner table and he would say, "Oh, I just bought a new stock for you guys for your college education." And he said, "Oh, I bought you some shares in this new concept in food or fast food." And he said, "I bought you some Kentucky Fried Chicken." And so that was one of the first fast food stocks. Or he would say, I came home and I bought some Disney for you. And at that time, all there was Disneyland. There was no Disney World, and The Wonderful World of Disney, which would be on at, I think, 7 o'clock on Sunday night. So we would watch that as kids all the time. So things like that. He was actually very good in selecting themes. He was extremely early on cable television stocks. I mean, people don't even talk about cable anymore. He just reads and he thinks of these themes that he actually gets aboard, and he has some nice runs. So that's where it first started. But he would bring home the evening newspaper. That's where you'd only get quotes at the time. And I remember going through and I was looking through the different quotes, and I found a stock trading at $1. And I asked my dad, I said, "Look, if I go into my room, open my drawer, get $1 out of my drawer, can we buy, a share in the stock?" Said it doesn't work that way. You got to do some research. We got to find some companies that are doing well. And a few nights later, he came home with the Wall Street Journal. There was an article on a company called Ward's Foods. They made, and you can probably still find these out there, Bit-O-Honey and Chunky candy bars. And so I thought, at that time, I was in my early teens, going to junior high school. and I bought 10 shares of Ward's Foods at 10, I think at 10 and a quarter. I still have the confirm on my wall that I bought it. And I still remember standing out in front of the student store where kids were lining up to get stuff, snacks at lunchtime. And I'd said, you got to buy these 2 candy bars. It never worked out. The stock went from 12 or to 10 down to 2. But I became fascinated of why my stock went down, and I saw other stocks that kept on going up. So, this is very strange for someone who was in junior high and then high school getting trial subscriptions to actually daily graphs, which is the precursor to MarketSmith. Right. And then also Value Line. I haven't seen a Value Line in a long time, but I know Value Line. I would get trials to that, and just fascinated. So that's where it all started, and then I actually worked. Then I graduated UCLA, and I had a friend who was on the floor of the P Coast, or the Pacific Coast Stock Exchange. He got me a job as a runner, and that was literally. It was actually shaped like a circle, and there would be specialists making markets and stocks. They would do a transaction piece of paper. I'd take the piece of paper and I'd walk it to someone who would teletype it in, and that would go across the board. I thought I was going to be, after a few months, picked up by one of these specialists and be an assistant and learn how to trade through them. And that never happened. And so I started, I was only there for about 3 months, but then I started thinking, why don't I get a job at the company that I already get products from? And I was getting daily graphs. And so I walked right up the front stairs of William O'Neill and Company and went to the receptionist and said, is there anybody I can talk to about a part-time job, an internship, anything? I'll work for free. All I want to do is learn from this guy, William O'Neill, who I've heard has done extremely well. So I actually talked to his assistant for about a half an hour right after that. Mm-hmm. And then I had an interview with Bill the very next day.
Wow.
And I don't even remember what I hopefully I was wearing a jacket and a tie, but no one had ever tested, or coached me on how to go through an interview. But it turned out that I liked some of the stocks that they were recommending. So he offered me a part-time job. I did that for a few months, and then it worked into a full-time job, and I ended up staying for 17 years. So that's kind of the short, quick story of how I got started.
That's awesome. And going back to the candy company being your first company that you owned, that's kind of almost the genesis of your idea that you want to look around the world around you to find ideas, find companies. I know you've said that in previous interviews. And often it's the products that we use ourselves that are going to go out and be those true market leaders.
Yeah, and I think people make the market so complicated. It really comes down to 2 things. One, what are you doing with your life? Mm-hmm. What are you buying? Where are you eating out? Where's your restaurants? What car do you drive? What phone do you use? What are your friends talking about? And then just matching up those concepts with some rules. Right. Is the stock in an uptrend? Does it have good earnings? You combine those 2 things and then also have some sell rules, and you should be able to find some very, very good stocks. Because just think of it, you're going to be trying to find the best product at the best price, or the best service at the best price. And millions of other people are probably very similar to you, and they'll be doing the same thing. So you're going to be finding some great names. And as long as the tax structure rewards innovation and entrepreneurship, these companies are just going to keep on coming.
Right, and you've called it the treasure hunt. That's the name of your chapter in Market Wizards. The treasure hunt.
Yeah. I mean, the whole thing. It's a game. It's like, well, what's going to be the next concept, the next company that's going to do really, really well? And that's to me, that's why it's fun. It's ongoing, and it's just a lot of fun.
100%. And going back to your very early days at William O'Neill and Company, tell us about kind of how you built a relationship with Bill O'Neill. What kind of mentor was he? Was he strict with you? Tell me a little bit about those interpersonal relationships and yeah, how you basically learned from him and developed your style.
Okay, well, it wasn't as you might think it would be, where I came in and then he would just sit down with me every day.
Yeah.
No, I mean, I was just a peon. I was working in the institutional department, which was a great experience because I was around probably 15 men who had been, men and women who had been in the markets and talking to large institutions, Fidelity, all these different mutual funds and banks, and I got to ask them questions, and some of them were good in the market. A lot of them were okay, but most of the time I was filing, I was making charts on sales projections or how well everybody's doing and things like that. It wasn't until I actually won a U.S. investing championships that I actually started getting attention from William O'Neill and was actually able to go in. They would have a Monday morning sales meeting where they would go over their ideas, his ideas for the week and what he wanted to do and things like that. And, as a, if I would say that was a good thing, but it was actually a little bit of a fault in terms of hiring people with O'Neill, because he would place so much emphasis on how well you could pick stocks that sometimes he would look past other things. So that's that was a good thing that I did well in the market. But so that's then eventually I started giving him ideas for their institutional product recommendations, and then started working more closely with them as I started doing that. And then I guess, I'm not sure if it was in 87 or 86, I think it was in 87, where he actually gave me some of the company's money to invest, and would be rewarded if I made money in that account. So I was, I guess, the first PM or portfolio manager within the company, and I guess they went on to have a lot more after I left or so.
Absolutely. And going back to how you learned, obviously you learned from the other people in institutional sales, but were there any books that you read, any other top traders that really influenced you and helped you along your path?
Yeah, so much of it was, I don't want to say it was self-taught, but the institutional salesmen, they didn't, they just kind of gave me an idea of what was going on out there. Right. But, and then O'Neill hadn't written the book yet. I mean, that book was not for at least another 3 or 4 years. I still have a copy of like the original, the original, which was just a pieces of paper with a binding on it and had no cover and things like that. And so and he rarely gave, every once in a while he would kind of give an in-house kind of Can Slim type of talk.
Right.
So it really was, I guess I learned from, they had books of their recommendations. It's called New Stock Market Ideas. And I would go through and I would start looking at see where they would make the recommendation, and then where it was taken out. And so I would learn that from that. But my biggest learning experience was from studying my own mistakes. Right. Because in 1982, I had an account that was at $30,000. I think I had $30,000. And then, the market exploded in August of 82, and I had a great move, and I doubled the account. Mm-hmm. Well, I was just part of a huge bull market. It wasn't really all my skill, and I really didn't know what I was doing. And so I was already at the company for a year, and then we got into a horrible market, or growth stopped working. Nothing was working. I started getting chopped up completely, and that account went from $60,000 down to $16,000. So that's pretty much blowing up. I finally sat down one weekend and I went through every single stock I bought for the prior year and found out what I was doing wrong. And I just found out that there was a pattern that just kept on showing up over and over and over again. It was I was buying extended stocks. So when I stopped doing that, I finally said, okay, I'm only gonna buy exactly at the buy point, exactly where the stock was coming out into new highs or above the majority of the base.
Right.
I'm gonna look for the right characteristics, and from that point on, I think very shortly after that, I got my first great winner, and it was a stock called. It was actually called Ward's, which is very similar to Ward's Foods, but Ward's Incorporated, which was an electronic retailer, which then changed its name to Circuit City.
There you go. Yeah.
And so had a great win out of that. And then just I was so focused. I wasn't buying pullbacks. I wasn't buying extended stocks. I was buying exactly right. I didn't care what the rest of the market looked like. And so I was buying one setup and one setup only. And that's where I just started hitting one after another after another.
Focusing on one specific setup and just trying to master that.
Right. I mean, you try to do a number of different things. You try to you try to buy breakouts and pullbacks and all sorts of different things, or you start mixing styles. That's where you can get into trouble. You just want to try to simplify the whole thing.
Absolutely. And how would you describe your own personal time frame? Like, would you classify yourself as a swing trader, position trader? And could you give kind of people a sense of your average gain, average loss, and kind of holding periods for both winners and losers?
I haven't calculated it in a while, but when I buy a stock, I want to stay in that stock as long as I possibly can. I do not like going in and out, in and out. You have to make so many decisions. Whereas I find a good stock that has all the characteristics, I want to keep in this thing as long as it keeps on going. And if it's only 3 weeks, that's fine. If it's 6 months, if it's a year, that'll be even better. Because I always found the stocks usually that I held the longest were the ones where I had my biggest gains on them. When I was, so in terms of time frames, I don't know exactly what my average holding period is. A lot of it depends on the market.
Right.
Depends on what stocks are working in the market. Sometimes, technology can be very volatile, and so those are a little bit faster. But things like retailers that can be a little slower and steady, sometimes I can hold those a lot longer. So it all depends. I've always said that even if you have a number of losers in a year, if you keep those small, but you have 1, 2, 3 really nice gains, you should do extremely well in the market.
Absolutely. And going back to your U.S. Investing Championship wins, how is it different competing in a championship versus your own personal trading? Are you taking up a different approach, or are you still doing the same thing that you would use today to trade your own account?
Well, I think in something like that, you want to turn over a little bit faster and always keep the money moving. And I think when I was investing in those or in those competitions, I would be much more. I would have fewer positions. I would probably have 3 or 4 positions, maybe 4 or 5 positions, and then every starting position would be at least 10%. And then if the stock started doing well, I would quickly get to a 20% position. And then if it had a really nice run, then I would sell that thing down once it looked like it was about to stall. So that was probably shorter term.
Right.
And I would be just constantly moving the money from one horse to the next horse to the next horse and getting those gains. The interesting thing about that is that though, after 3 years of doing it, I also entered a 4th year in a row, and there I was so focused on the results that I started getting away from what I had done well. I was more focused on the results and not enacting the strategy the way it should be.
Right.
And so I started. I would be taking too big of a position, and so I would have too much in any one stock, and I wouldn't give it enough room. And so actually, the 4th year I was flat, and then the 5th year I actually came in second. So So that's just sort of like the end of the story, other than the 3 times that I won, that yes, you can get so focused on the results that you don't do what you should be doing.
Right. And as somebody who's been doing this for decades, you can answer this question. How is it different today trading versus back in the 80s, back in the 90s?
Well, I think that, the prices of stocks, I mean, I remember, well, most of the time before probably year 2000, is that there were very few stocks that ever traded over $100 a share. Now you've got all these stocks that are trading at ridiculous prices, and they're moving 20 points in a day or 50 points. It's just, I wish they would split them so there would be it's still hard to get used to stocks making such big moves. But in terms of how it's really different, I am a big believer in, well, I mean, if you want to, let me step back 1 second.
Mm-hmm.
We're talking about investment books and things like that. My biggest investment influence is actually, and this would be a shock because no one ever talks about this, is the Bible, God's
Mm-hmm.
word. There is more investment advice in there than any book ever written, in terms of just controlling your emotions, fear and greed and discipline. And probably one thing that I base all my almost all my investment criteria on is a passage found in Ecclesiastes, and it's something that a lot of people have heard before. Ecclesiastes 1:9, it talks about there's nothing new under the sun. What was before, it has already, it will not, you think things are new, but it's already existed before.
Right.
And
right.
so when you talk about, well, how were things back in the 80s, or when you in these investing championships, I'm buying the exact same stocks, the same characteristics now as I did then. And you can look back at charts from I was looking at a Bethlehem steel chart in 1915.
Yeah.
Had all the exact same characteristics as a lot of these stocks do today. So there's really nothing new. It just repeats over and over again. And the only thing that's different is the name at the top of the chart, because they have very, very similar characteristics.
And those are the can slim characteristics,
yes,
great earnings, sales. Yeah.
Exactly. That's, the things that, as I find, everybody's looking for truth these days. What is true? Well, God's word to me is true, and it's been true for 2,000 years. And I say the same thing about what O'Neill laid down. I think what he's laid down and the characteristics he originally found is really the truth of how the market works.
Mm-hmm.
So there's so many parallels between what he's discovered and what God laid down, is that this is how stocks, they operate. If a company has great earnings or a great product, they're going to have great earnings. People are going to want to own that company,
right?
And stock price is going to go up. I don't know how that's going to change unless there are, unless again, tax reasons clamps down on entrepreneurship, and we don't have any new products and nothing new is made. So anyway, that's, I find truth in really, one, in terms of the market and how you should act and how you should trade in the market, and then how you should believe and how you should live your life.
Right. And going back a little bit to your time at O'Neill and being the chief market strategist, what are kind of a few key things that O'Neill would kind of repeat? What are some keys that he passed on to you about how to trade and how to manage your emotions and manage positions?
I spoke for a conference. I think it was the last, I don't know what they called it, the last investment seminar that William O'Neill and Company, that they gave. That was a few years ago in Santa Monica. And I wrote down all these things, and I had, and so if I could I'll just
Yeah, go
quickly
for it.
just go through what I got. I mean, he's always said he's always was an optimist. He's never forget that this is the greatest country in the world, and you have just so much opportunity. He would say that all the time.
Yeah.
He would always stay positive, and he would also stay humble.
Mm-hmm.
And even against unrealistic odds, against going against the Wall Street Journal, he promoted a newspaper and was fairly successful with that newspaper, even up against incredible odds. And then a few other things. He said, always know the direction of the economy. If there's underlying strength to the economy, that usually corresponds with a good market. Be flexible to change your market stance is something that he was a master at doing. When I just remember there would be bear markets that go on for months and months and months, and everybody's in a bad mood, or no one can make any money. And all of a sudden he gets his follow-through day, and he's in there buying stocks while everybody's just sitting around saying, well, it's such a bad market. I can't, what. And he's actually getting fully invested, and everybody else is sitting on their hands. So it's good to be flexible. Details are really important. That's something he stressed in the products that we put out at the company, and the same thing in reading a chart and looking at the characteristics of a stock. The littlest detail can make a big difference between a stock being just an okay stock and something being a gigantic winner. Another thing, you never need a manual to the most successful products ever introduced.
Mm-hmm.
And he gave the example of the car. You either push the button now or just turn the key and step on the gas and off you go. You don't need a manual.
Right.
And that's the same way when I remember in the mid to late 90s, we started coming out with online products. And I was one of the first ones to sit down with a programmer. And Bloomberg was out at the time, but we wanted to put everything online. And I just kept on telling the guy, we don't want to have anybody to know keystrokes or any backslash things that I think a Bloomberg terminal you need to work with. I said, maybe this is an insult, but I said, develop it for the village idiot. So anybody can sit down, anybody without any technical know-how, and just be able to point and click.
Make it intuitive. Yeah.
Very easy. You don't need to read the manual and what's going on. So then always do things the legal way. Buy the book, never cut corners, because especially when you're working for a firm or you're in the business, there's also compliance that you have to go along with. You never want to get into trouble with that stuff. Keep it simple. Bill only looked at weekly charts. He wouldn't look at daily charts. Not until I think I started showing him daily charts, but he would always concentrate on the weekly and wouldn't go back and forth. But the weekly actually just takes out a lot of noise that's going on intraday and interweek in the market. And then always challenge the common wisdom of Wall Street. There's just a lot of common fallacies in the market that people keep on repeating over and over again, and he would always challenge that. And then the last thing was work hard and remember what's important. Success comes through hard work. But I add on to that is that work hard, but there are things that are more important than your performance in the market. Because I've seen so many tragedies in the markets over 40 years. I've seen people commit suicide. I've seen people have families break up, marriages break up because it becomes so important and so overriding. It's not worth it. So keep a perspective of what's really, I go faith, family, and friends are the three things that are really important out there.
Absolutely. That's well put. And being in the industry for 40 years, I'm sure you've had your ups and downs and dealt with losses. How do you get out of a rut when you're not trading to the best of your ability and nothing seems to be going right? What kind of steps do you take to kind of try to turn things around and get back to your A game?
I just, if I've had a number of stocks, and let's say it's 3, 4, 5 stocks in a row that I'm buying and they're just not working out, then I just immediately start slowing down. I don't take as big of a positions in the stocks that I'm buying, smaller positions, and I just wait until things start working, and then I start increasing my positions. Because if things aren't working, either the market's getting tough and it's about to go into a downtrend or a choppy period, or you're just not picking the right stocks. And so why keep on forcing more money and taking bigger positions and saying, well, I got to make it back. It's really just taking it one stock at a time and try to get that one winner and then get another one and then start getting that confidence back and increasing the size of the positions.
Absolutely. And do you have any advice for mindset or risk management for younger traders out there who just got started in the past few years?
If they're just getting started, and they even if you've had a few years of experience, I mean, just like I think about somebody who just started, since March of 2020. And all they've seen is mostly an up market with very few corrections. That type of market, and even the market, today is, to me, is not. It comes along once every 20 years. This happened in 1999 and 2000, and it's happened again in 2020 through 2021. A lot of people don't know what a bear market is, and they just think it's just one stock after another, and we all jump aboard this one, and everybody's talking about this one. But there are going to be bad markets that come along, and if you really don't have that much experience and you've only been in for a few years, I would actually take a majority of your money and put it somewhere else where you can't trade with it, because sooner or later we're going to get into a bad market, and you're going to lose back probably a lot of what you've made, because you've had just the experience of it. Everything only goes up, and you don't really have to sell because you'll get bailed out eventually.
Right.
So to me, it's not really, sooner or later it's going to happen. We just have an event of so much liquidity. The amount of money that the Fed has pushed into the economy has found its way into the market. And until they start tapering or start raising interest rates, this is probably going to go on for a while, where we're going to have this rotation, one group 1 week, and then the next group, and it just keeps on rotating around. So, but I'd tell them to go slow, and also to use a smaller portion of their money. Learn from your mistakes. You'll learn more about yourself and your own trading by studying what you do right or wrong.
And diving into that a little bit, what kind of recommendations do you have for people who want to do post-trade analysis? What's kind of your process? Do you pick the best 5 winners you had, worst 5 losers? How do you kind of go about it?
Yeah, you can. Now these days everything's online. All your trading is online, and so you can go and see what have been your biggest gainers, biggest losers, and then go in and start studying those. And the other thing too is it's good to do is to screenshot charts of the stocks that you're buying,
right? Put
them into a file, and then just go back a month later, 6 months later, and just study where you went in and why were you buying at that point. It's also good. I used to print the charts out because we couldn't save them to anything, and you just print them out and write on them, and then just look at them and see, and then print out the chart after the transaction's over to see where you went right or where you went wrong. But that will expose things about yourself that you probably didn't know. It's actually very hard to study your mistakes too. A lot of people, they don't want to admit they've made mistakes. But if you can be humble enough to admit that you're wrong, study where you went wrong, and then correct that, then you'll do a lot better in the market. But it takes humility to be able to do that. Yeah.
And it's almost like athletes studying game film of the good and the bad games and trying to find their weaknesses and also what they're doing right as well.
Right, because I've had people who've written me or asked me. I said, "Oh, can I just sit right next to you and see what you're doing, and or you can see what I'm doing?" But I don't know the thoughts in your head. I don't know your mental makeup. I think there's a certain makeup of an individual who can be successful in the market. They have to be very disciplined. They also have to have a background of being able to take risks. Be able to admit mistakes and take a loss. That's so important. I've always said, you got to, when you come into your trading office or room or wherever it is, you have to take your ego and throw it in the trash can and just be able to admit, hey, I'm going to make a mistake. I'm probably going to make a number of mistakes, and I just got to learn from them and move on.
Absolutely. And you've kind of already touched on this a few times, but how important is lifestyle when it comes to trading and investing? You've talked about how you don't want to be too active because then you have to make so many decisions. So yeah, how do you take that into account? How much time in front of the screens? And what are your thoughts on that?
Yeah, I almost think sometimes it's better not to be sitting in front of the screen the whole time, and actually get away or just even turn, and maybe not turn it off, but go to another room and do your reading and do your research on individual companies, than sitting there and watching every little tick going up and down. I mean, I guess you have to do that if you're a day trader, if you're very, very short term, but if you like to take positions and try to stay with them for a long period of time, then it's actually better not to look at the intraday swings, because sometimes these a 10-minute chart can get you could start going, oh my gosh, this thing's getting killed, where then you step back and you look at a weekly chart and you go, there's nothing wrong here.
Right.
So you have to, I guess, decide on what time frame you want to be trading, and that will dictate how much time you're sitting in front of the screen.
Absolutely. And I've done a lot of interviews with some veteran traders like Mark Minervini. And one thing I always like to hear about is their weekend and also daily routines and how they go about like preparing for the next day to set themselves up for success. So would you mind kind of walking us through what you do on a weekend to analyze the market, find stocks to trade for the next week, and kind of narrow your focus to only the best opportunities?
Well, I spend a lot of time, usually on a Sunday afternoon, Sunday evening, going through as many stocks as I possibly can. I look at I'm almost exclusively using MarketSmith charts, and I'm going through a bunch of screens. I go through, they've got a MarketSmith 250, which is the best stocks based on earnings and relative strength. I go through all of those. I have my own, I call it my own monitor. I call it data monitor after a product that O'Neill used to put out, where it's just a list of stocks that I constantly add some to, and I take the ones that aren't performing well and I take those out. I go through those, and then I'll go through maybe a few different other screens that I have set, and I'm just trying. Then I go through a lot of group charts. I like to look at the top 50. I like to see what's moving to the top 50 groups out of 297 they have. And so I'm trying to see, is there a group theme that's coming on? Because lots of times when a stock makes a great move, it's along with a group. So if I can, I actually try to get through as many hundreds and hundreds of stocks as I possibly can. And that's one, I've always said it's one problem, and they're trying to correct it at MarketSmith, where most of the time you can only go through one stock at a time on your screen. Now on the iPad, you can go through about 4 at a time.
Yeah.
And so that helps. Because I used to go through when it was daily graphs. You would have a blue book, you would have a green book. One was New York, one was over the counter and American, and that was 2,000 stocks. And I could flip through those really quickly, and I can go through both books in a couple of hours. Now it takes me twice as long to go through 600 or 700 stocks. But I think they're working on it, and so I think the technology will finally kept up, but that was a step back when they eliminated the printed product and went only to this one.
So looking at all those stocks kind of give you a sense of what groups are setting up, where to focus your attention, and also on the overall market health as well. And the
I get the greatest feel for the market from looking at so many individual stocks, and are there new stocks that are breaking out or setting up. And the thing about this market is that it's been, even as the market has been coming off, there's still stocks that are holding up or they're breaking out. Usually in the past, when we'd go into a correction, there wouldn't be anything to buy and they would all be rolling over. And so, the rotation that keeps on going on, but you can find that by going through as many stocks as you possibly can to see these different trends.
And on Sunday, how many stocks do you have on your focus list for that next week? Kind of how many stocks are you narrowly kind of choosing between for potential buy opportunities going into next week?
Well, I probably come up. I mean, I don't know. It looks like this week when I look at the list that I have,
there are a lot of setups this week.
I don't know. I probably had about 15 different stocks that look pretty good, but I narrowed it down to a few stocks. But then I also have a number of alerts set on other stocks. So when the market starts off, I start having all sorts of alerts going on. So it's not just the list that I went over this week, but some of the alerts I set on stocks from the prior weeks.
Right. Makes sense.
So, and then then during the week, every day I'm going through and I'm running, also running screens or just seeing what's acting well, what sectors are acting well, and just doing more research, looking at more stocks.
Awesome. And getting into your daily routine, can you kind of also walk me through a typical day, starting from the pre-market to when the bell rings? What time are you waiting until to potentially enter a position? And also, what are you doing after the market closes?
Yeah, one disadvantage, it's a good thing, it's a bad thing about being on the West Coast in that the market opens at 6:30.
Yeah.
And so, you have to get up very, very early. And now that I'm not managing money for other people, I don't have to get up as early, but I'm usually sitting down at around 6. So I got a half an hour to kind of catch up on the news and look at the stocks that I might be buying or adding to. And then, but the good thing on that is that the market closes at 1, and I usually spend another hour or 2, but then I've got the whole afternoon to do stuff. If you have a family, I actually thought this was good because I would get off to work early before anybody woke up. And so we have 5 kids. Now they're all fully grown. And but I miss the chaos of the morning when everybody's losing their lunch and they forget their homework and things like that. But I would be able to pick them up from school at 3 o'clock and things like that. So there is advantages on the other side to all that. But I would do more work after the market closes, looking for more other ideas, things I missed and such. But I would, go again, look through Market Smith 250 to see what might have broken out, what I missed and such. So I a lot of it on Sunday and then additional stuff during the week.
And when that bell rings and the stock pushes through a pivot that you're watching, are you waiting until half an hour after the bell, 45 minutes after the bell? Because often stuff can reverse very early on in the day. So I was wondering how you kind of handle that.
Yeah, I usually like to wait. If I make more mistakes, where I make most of my mistakes is if I actually start trading too early, because it's amazing how some of these things, they gap up 2 points. They look like, oh my gosh, here we go, the thing's breaking out.
Yeah.
You buy it and then a half an hour later, you're already down a couple points because it's just pulled right back in. Same thing on the on the downside, you think, oh my gosh, I got to kick this thing out because it just broke support. 45 minutes later, it starts marching on back. So I actually like to wait for the market to calm down. And sometimes I miss something. Sometimes it breaks out and it gaps up and then it just keeps on going. But what you can do is just maybe even wait the first 10 minutes and see if it makes a new high and go with that. But I've seen so many stocks. I you know, they actually gap down. I go, why did it gap down? I mean, not a huge gap, but the thing's down 3%, 2%. And I look around, I can't find any news. And then the thing starts marching on back. So you just got to go a little bit slower in those first 10, 15, 20 minutes because there's just all sorts of strange things going on.
Absolutely. And now I think it'd be awesome to talk about kind of the current market conditions and also get into some leaders and stocks you're watching. Maybe you could go ahead and share your screen and bring up MarketSmith, and maybe we can, to start things off, bring up a chart of the QQQ, another index that you're watching, and talk about how you're viewing the current market conditions.
Okay. Share. Okay, you're seeing it. Okay. Well, there's QQQs. Actually, you know, I mean, it's actually coming back up to highs. But if you look at this, and if I can, let me get my line pan going. This actually hasn't been outperforming the S&P since February of this year, and so I'm thinking it's losing a little bit of steam. I mean, it's still nice. It's still back into an uptrend. But the other thing, it actually came down on some pretty big volume.
Right.
And now it's rallying on some pretty light volume. So it's just something to keep an eye on. And then the spiders, you know, the S&P looks stronger. It's gone into new high ground because it's a little bit more diversified. And now you got oils and financials, which hadn't performed well. And so this is not so much concentrated as like the NASDAQ or the triple Qs are. And then the Russell, same thing. The thing's been, look at the relative strength that this has been going against for the longest time. So it's still, you know, mega caps. These are, Russell is smaller, but I would think this would start doing well because it does have a lot of financials in it. So it's been a really, I mean, I call it's a huge rotation market, moving from group to group to group. And at the beginning of the year, I was on IBD Live, and I think it was the first week of the year, and I was saying, hey, a lot of these technology stocks have had a huge move, and they're starting to get very, very volatile. And I said, you got to start looking at these other groups. And this is one that actually started performing well. And I'll give you, that's a daily. Here's a weekly. Here's the fertilizer group. And I was saying, hey, look at the fertilizers, look at the steels, look at some of these ones. And everybody was going, what, are you kidding? These aren't growth stocks. Well, there are times when growth stocks don't work, and things that haven't done well in a while, or commodities and prices start moving higher. And I got a terrific move in the first 3 or 4 months of the year by looking at this and looking at some of the other, the other stocks. Oil and gas stocks started doing well. Steel started doing well. And then technology started coming back again. It rotated back in. See, so here's the beginning of the year. In January, you had just a continuation move of this whole move from the bottom for just another month or so, and then it turned into a real chop for the next 3 or 4. Well, that was almost 5 months period of time, and then we got this move. So it was cyclicals, then it was back to growth, and now it's like every week it's a different group, a different area. And so what I'm constantly doing is I'm just going to look and see what has done well during this year what has sat out for the last 2 months and what could be coming on again. And that worked. And that just worked extremely well today, because in the last couple of weeks, I've been starting to look at the steel stocks again, because they had this great move and everybody was talking about them, but then they got out of favor, or the group, and it came down. But really, if you look at it, it only got a couple of days of bad volume. And then they report it. I mean, look at the earnings now. And you have to be careful when the earnings are extremely good on cyclicals. You're usually towards the top, but really you've only gotten about 4 quarters so far of big earnings. And I think you've got some more quarters to come on these stocks. But anyway, but you just take the groups that were strong, that are out of favor for 4, 5, 6 weeks. You start looking for a turn, and that worked well there. Steel Dynamics, similar situation. And then oil and gas, these had a great move at the beginning of the year. See, I mean, since December, here's Callon Petroleum went from, 15, 16, all the way up to 60.
Yeah.
Came down now and corrected much too much that I like, but I still bought this as it was starting to turn, and the price of oil took off, and it had a terrific move. But other ones in the group, like Oasis, you can see all the alerts I had on this one.
Yeah.
This set up again after a terrific move. Set up really a cup and a lower handle, and then that has had a move out. Denbury, I think this is a little bit slower, not acting as well, a little bit choppier. But let's see, Oasis. Oh wait, I already went on that. But EOG, that's another one. See, had a nice move, came down, and then started turning and has set up a consolidation and is moving out again. And then, I mean, then you've had technology stocks that that have had great moves. I mean, this one really only gave you one chance, and this was only a couple week pullback, but that's been a good mover. So, and then you have some new issues too that have done well. So, but it's constant rotation, and you just have to try to stay in front of it, and almost and buy when they break down trends, because lots of times they get to highs and then they start stalling and then they pull back. And it's a little bit harder to buy pullbacks that have worked, rather than get in a little bit earlier before the stocks move higher.
And David, when you first bring up a stock chart that you haven't seen before, what does your eye go to first, and how do you kind of move around the screen and analyze both the technicals and fundamentals of a stock you've never heard about before?
Well, I usually just let me just, like, I was looking at this one today, Advancic, ASIX. The first thing I do is I look to see, and you can see the different trend lines I've put on here. I look to see, first of all, is the stock in an uptrend?
Mm-hmm.
Is it close to its high? And then I focus in, is it extended? This has only gone sideways for a couple of weeks. So I actually like to see longer bases. I mean, this is a better buy situation right here, where the stock's been in an uptrend, goes back and forth for 5 or 6 weeks, and then it comes through. To me, I like the longer buy points better than these short bases, because I think short bases usually get short moves out of. And so, but I first focus on, I'm always just looking over here, and within a few seconds, I can say if I'm going to spend any more time with this stock. Let me just, I'll bring up randomly. Here's IBM. Okay, gap down, bad relative strength. I don't have to spend more than a fraction of a second on that, saying It's
Yeah.
gone. I don't want to look at that. Let's see, DuPont, 37 relative strength, downtrend, no. So, okay, here's a better one. AMD. Okay, AMD, yes, this has been a strong stock. It's been an uptrend. Okay, but now I look at this and I go, okay, well, it should have been bought somewhere down in here,
Yeah.
where the majority of the base was. It's up here. It's extended. I think it looks strong. I guess they have earnings in a day. That's another thing I don't want to buy right before earnings. It's extended. I'll put that. I click this button. I put it into my data monitor, and so I'll look at it again. But within seconds, within a fraction of a second, I can tell if I should spend any more time on it.
Mm-hmm.
And then once, let's say I find something. Let's see, I look at something that's got a nice longer base on it. Okay, this is about a 5 or 6 week base on it. Nice uptrend. The group is not in a great group, but if they ever pass infrastructure, then this company will do well. I've done well in the past on this stock a few different times, but then from there I go to I say that the chart looks good. Now it looks like it's breaking out, but then I go to the earnings down here. All those look good. Then I go to the weekly, and I like to see, are the institutions, the institutions actually have dropped in the last couple of quarters, so that's not a good sign. And then what kind of growth rate? 28% growth rate. So I just start going through the CANSLIM characteristics, but it all starts with looking at the uptrend and the consolidation of the stock.
So just to kind of summarize what you're saying, you're looking for a strong uptrend, and then within a base, you're looking for price tightness. Is that kind of what you're looking for very quickly?
Yeah.
Okay.
Yeah.
And I think it's really interesting. I've heard you say this a few times. You're looking for a breakout through the majority of the base. Basically, it doesn't have to be the high of the base, which is kind of the standard pivot. So could you talk a little bit about that, kind of any alternate buy points that you use, or consolidation pivots, that type of thing, to get in a little bit earlier than the true breakout?
Yeah, I mean, for something like this, I mean, the high at this point was 101.96. But if I take this and I try to make it so simple, and this, I think, has helped a lot of people. I just say, draw the line, find where the majority of the base was built under. And that's where your buy point is. So many people, they're looking for cups and handles. They're looking for double bottoms, triple bottoms. They're looking for pocket pivots. They're looking for low cheats, high cheats, mid cheats. They're looking for all these things. And I just say, look, don't make it complicated. Just draw the line over the majority of the base. And I'm saying like 90% of the base. And that's probably where your best buy point is. Yes, you can look for lower areas, but I would say that's only for people who are more advanced to look at these buy points, because you still have overhead supply on these things that are lower down in the base.
Right.
And I just don't know if those work as well as something that's a little, higher in the base and still has all the different characteristics.
Makes sense. And could you talk to me a little bit about how you incorporate the relative strength line into your analysis? Because I think this is really a hidden gem that a lot of traders don't even use. And I was wondering how you use the relative strength line versus the RS rating, the 12-month RS rating, into your process.
Yeah, the RS rating, the number itself is just a general idea of how the stock is done. But the problem is, and I don't know if I can think of one right off the top of my head, of a stock that had a great move and now is corrected 50%. It could still have a 99 relative strength. If you
I think Zoom last year, that was the case with Zoom. Yeah. I don't think its RS rating is that strong anymore, but back when it was correcting 50% off the highs, it still had a 99, I think, just because of the super strong, powerful move.
Yeah, let me. I'm just thinking of things that a lot of these are now, their relative strengths are a lot lower. But because what is happening is the relative strength number is calculated over a year period of time, and if I take like this this is a year. Well, no, that's the beginning of the year. If I take where we are, this is a year period of time on Peloton, and so 20%. 20% of the rating is this action. 20% is this action. Another 20% is this action, and the last 40% is this action. So there's more weighting on the last quarter. But if you have this huge move here, then and the stock's off 50%, you still might have a very, very high relative strength number. I like to look at the relative strength line, and that line may be easier to see if you look at the weekly. That line is against the S&P 500, which is a little bit more constant. And so you can see, even as this stock was, still staying at highs, the relative strength line was starting to break. So I put a lot more weight in how this stock is acting relative to this line, and you can see even this. A lot of people are going, okay, maybe this is a buy spot on this stock. It looks like it's starting to break out and it's formed a big cup, but look how it's acting on a relative basis. This is where the relative strength line was the last time. It was at 124. Now the stock actually hits 129, and the relative strength line is actually lower.
Right.
Saying that this thing's it's just not acting well versus the market. So I put a lot more weight into how this is doing. So you can see some real divergences that are occurring when stocks are making new highs and the relative strength line is not making new highs. And I mean, here's an example. Look how well Amazon was acting on a relative basis back here.
Right.
Stock actually breaks out of a base. Everybody's getting excited. It goes for 3 days. Look where the relative strength line is now at this point versus where it was even at lower prices back before. It's not the same stock. It's not as strong as it was before. And so that's where you have to be careful of stocks breaking out. If the relative strength line is nowhere near the high, you have to be very suspect. And so and then you can also use it on the downside when the relative strength line is starting to rally.
Yeah.
And this isn't a good example. When the market's in a downtrend and the relative strength line is starting to rally in a bad market, that's a very good sign.
If you actually look at Amazon back in the 2020 correction, you had a great example of that. The RS line is making new highs before the price within the base.
Yeah, here it is back here. Yeah, look at the relative strength line going up. But yeah, now look at the relative strength line.
It's in decline, yeah.
Yeah. And that's where a lot of people have to get out of their mind a great company versus a great stock. You want a great company and a great stock. And Bill said this. I think a lot of people have said this. The only good companies are the only good stocks are the ones that are going up. Who wants to hold one that's underperforming and going down?
Exactly. I was curious to know your thoughts on this. What do you think about concentration, being in only a few stocks at a time? And how many stocks are in your typical portfolio now? And how is it different back when you're kind of trading in the U.S. Investing Championships and kind of building up your capital over the years?
Yeah, now I tend to spread out more. I usually go 10 stocks, and 10% in each position. But if something is acting well and actually even has had some nice upside, then that could go to a 15 to a 20% position. I'm not as concentrated as much. I don't have to push it as hard, but I still have that voice in the back of my head from O'Neill, saying you got to take advantage of great stocks, and if you're not up 100% every year, you're a failure. So I've always had that in the back of my mind, and that was the pressure about working there, is that you had to keep up with him, and he was so good. He was somebody I've never seen anybody do this and do it as well as he has, is take the whole market and boil it down to one stock and put everything in that one stock, fully margined, and stay with it the whole time. I mean, I still remember talking to the CFO of the company, and he said, yeah, what Bill would ask him every day is, how much buying power do I have? And just keep on buying and buying and buying, you know, something that, but he was able to take the whole market and identify the real big leader and be able to put everything in it. You know, I want to sleep at night. I want to make sure my family's taken care of. I don't want to be fully margined. I don't think I've been on margin in like 7 or 8 years, because but the one, and then the thinking about that, it's not like, oh, the guy's a chicken and I don't want to go on margin. If you're dealing with very strong, I call them high octane stocks, you know, a lot of canned slim stocks are very high growth. They have more volatility. And so when I'm 80% invested and I've got a number of these stocks, to me, that's the equivalent of being 140% invested, because they have much bigger swings than the general market. And these days, I like to have a mix, have a few very high octane, but then some other ones that are just stronger growth stocks, and some that are a little bit, you know, a little bit slower. But because it, again, I've been there where it's like one day all of a sudden, click, the light goes out on your growth stocks and they start falling so fast you can't get out fast enough, and you start losing 10% in a day, and you go, oh my gosh, what is, and you can't sell fast enough. So anyway, that's, you know, and then as you get older, maybe get more conservative, and you don't have to push it. So
Gotcha. And I was just wondering if you kind of have a favorite Bill story that you'd like to share with everybody listening. Yeah.
A favorite Bill story. I
kind of put you on the spot there.
Yeah, I don't know if I have he was, you know, he was very, you know, very focused on really pushing, I mean, and really emphasizing that this is the best way to make money in the market through these growth stocks. And I still remember meetings, Monday morning meetings with the salespeople. Well, when somebody would come up and says, hey, well, I've got a manager who is a value manager, and is there a way we can develop a product for him or a screen for him to help him pick stocks? And Bill would just chop that guy to pieces, and everybody, no one wanted to look up because we just knew what was coming. And because he would say, what is that guy doing? You got to convince him he's got to be a growth manager. That's the only way to make money. And so he could be kind of ruthless going after people who didn't really fall into his philosophy. So I don't know. The other thing is, I guess this is just a minor thing, is that around when I first started doing well, and I was able to place orders in the trading room, the institutional trading room, they would call him the Bullet, and I would be called the BB, because I was the younger one, the smaller one. And when that would how they would designate our trades of who it was for. So that was my nickname going way back a long time ago. Yeah.
And also just curious, what was it like being interviewed for Market Wizards way back when, along with O'Neill?
Well, I guess he was interviewed in his office. I was in a cubicle among probably about 20 other cubicles. And I think I haven't read it in a long time, but if you read the description of where I worked, I mean, back in those days, the terminals where you would get quotes on, there were these bunker Ramo machines, and they were very expensive, and you would actually share it with the person on the other cubicle on the other side of the wall, and there would be a divider cut in, and you would just move this thing back and forth. And that's, you know, we didn't have all these charts and computers, and that's all we had. You had to update your daily graphs by hand. You would put a mark in on your chart. And so yeah, I think Jack Swigert, that he just sat I had a chair in my cubicle, and that's where he interviewed me. But hey, that was fine as long as I had quotes and I had the charts to look at and all the information. I was happy. You don't have to have a zillion monitors and a giant office. You can do this now anywhere on your iPhone.
Yeah, yeah. And getting back a little bit into how you trade, when you establish a position in a stock and you've kind of got a desired amount of your portfolio you want to invest into that stock, do you go in all at once, or are you kind of waiting for the market to confirm that you're actually right and kind of pyramiding up into the position?
Yeah, I like to. I usually like to start with like a 2.5 position, and then even on that day, if it starts confirming, then I might go to a 5% position, and then the next day, if it continues to follow through, then I'll try to quickly go to a 10% position. When I'm buying a stock, I'm feeling that my expectation is that stock should go up immediately when I'm buying if I've timed that stock correctly.
Yeah.
And so I have the expectations that it's going to start going up. If it doesn't go up, then I'm not going to add to it. If the market doesn't confirm my thinking, then I just won't make it a bigger position. Especially if it starts going down, I'm not going to be adding to a losing position. So then, if it turns around, then I will. But yeah, if I'm so sure on my timing that it should almost be hard to buy too. I should be buying it and it starts taking off and it's actually hard to buy stock.
Yeah.
and getting a position. The best stocks are the stocks you're up immediately on. Those will usually be your really big winners. So and it's only add to the really big winners, or only add to the stocks that you already have a profit in. And then where you make the big money is if you do it. I think you get a multi-month, and then even a multi-year move where a stock you buy it once and it takes off and it has a great run. It makes a new base, and then it breaks out and goes again. Well, you can double your position at that point. You can add more to it, and then because that's where you get the compounding effect of just adding more money to those winning positions.
Gotcha. And just to start to wrap things up, I think it'd be awesome to walk through a base. I don't know if you've got an idea in mind, a recent stock that you bought maybe, and kind of see how you analyze that base, look for those little details that tell you that's under accumulation or it's under distribution. And yeah, just kind of see how you read a chart pattern and basically let the stock tell you that it could be a high potential leader.
Well, this is a good example, and this gets back to this is Generac, and I've actually gone over this a few times. But here's a stock that had a 5-year base, and here's a stock that I had a need for in actually 3 years, almost 3 years, a little under 3 years. There was a huge fire that came through Malibu. And it burned down thousands of utility lines and utility poles. And we were out of power for 18 days. And I needed a generator. I was actually looking for one even before the fire came, because every time Southern California Edison there would be high winds, they would turn off the power.
Right.
So anyway, I looked into a generator. I actually bought a Generac generator, and this is where the fire hit, and then I got it installed like right about here, and then it's set up just perfectly. But I love the long base. Yeah. And you can see that the stock broke out, and it broke out on a lot of volume. And you can see that it had a great move up. I mean, it doubled in price. It went from 60 to 120. Then we got into COVID and the lockdown, and then it set up another base. And then so here was a whole new buy point. And you can see it's actually had a few bases along the way. Here's another one. And maybe I can go into the daily and show you that. Yeah, this is more, here it is breaking that downtrend. And I'm not sure why it had this, there wasn't any earnings here. It might've been a secondary. It had one huge day of volume, and it did have some distribution here, but look how this stock, how it started changing right around at this point, where just look at the color of the blue volume, how the volume changed, and you got multiple days in a row. And I always love to see that. The bigger the volume, the better. Mm-hmm. And it had actually had 3 days down. I mean, if you take from really from almost this point to this point, this stock looks like it traded, I'm just guessing, 22 days up and maybe 4 or 5 days down.
Right.
And just showing you that, just a tremendous amount of buying, especially when you get it above average daily volume. The other thing I like to see when a base is forming is sometimes, I call this an undercut. Some people call it shakeout. It's the same term. And what this is that it didn't undercut over here. It undercut this price. Mm-hmm. And so what it does, it scares all these people who bought the stock during this section in here. So you get out the weak holders, and what you want to see is the stock turn very, very quickly. And we'll see that, yes, now the volume started picking up and it started coming up and out of there. So then, I mean, you could have gotten an early start, but here is just make it simple. Let's draw a line over a majority of the downtrend, and that gets you in, right? You would buy it on this breakout, pulls back, and then you can add to it, and then you get a terrific run out of that stock. Now it's chopping back and forth, but it's still in an uptrend. Relative strength line is still confirming, and along the way too, all the new highs have been confirmed by the relative strength line. So now they're about to report in another 8 days. But from what I've heard and read is that you put in an order for their generator and you're waiting 6 months to get delivery. So there's a huge demand out there. I mean, every time there's a storm, I mean, even the electrical grid is not very good. Yeah. And I mean, all the different problems we've had over the last year, from freezing in Texas to fires in California, it's almost like you almost need one of these now, because you can't depend on the utility company.
Right. And all those days up in a row are basically with very few down days. That's kind of similar to your ants indicator, right?
Yes. Yeah.
Can you talk about a little bit of what that is? Yeah.
Yeah, that's something I came up with back when I was running the mutual fund for William O'Neill and Company, the New USA Growth Fund, because what would happen is that we would stick to stopping our buy at 10% out of the base, and I would see that the buying would just continue on afterwards, and those turned out to be some of the biggest stocks where we would finish their buying. There were still other institutions that were out there buying it. So I asked the question, what's the difference between a stock that's going to make just a 20% move and be done with it, or a stock that's going to have a multi-year move or a multi-month move and have huge performance? And I found that it was usually the buying at the beginning of the move. And you can actually see it's occurred a few different times. I mean, here it occurred over in here. And then you can see it occurring over here. And so what it tells you is that there are institutions out there that they do a tremendous amount of research, that they found that, hey, this is a company that could have a great growth for a while, and they have 3 million shares to buy, and they can't get it done. Especially, let's say, I mean, today the stock trades 600,000. So even if they're buying 3 or 4 million shares, it's going to take them a number of days, if not weeks, to complete. Yep. If you have more than one institution doing the same thing, then this can go on for weeks. And that's what I found. This is just showing you huge institutional money getting aboard a stock and taking a long-term position in it.
And that's what creates the trends that we can ride as
Right.
retail investors. Yeah.
Yeah, and the characteristics are, this is what I kind of boiled it down to, is you want a stock that is up 12 out of 15 days. You want a stock that has about a 25% move during those 15 days, and you also want the volume up 25% during those 15 days. That's just the mark of a number of institutions taking a big position in a company. The one other thing you have to be careful of, though, is if the stock has been moving for a long time and you get those exact same characteristics, like might have actually happened here.
Yeah.
Is that it's actually sometimes it was just a great indicator, because we found it was showing up at the beginning of the move and it was showing up at the end of the move when the stock was getting very extended. And so it was the first time I'd ever seen an indicator that could work both ways.
Right.
And the climactic move is when everybody recognizes it and everybody can't take it anymore, and they've all got to buy it. And that's usually the climactic move, and the stock's over. In this case, it was over for about 3 or 4 months, but in other cases, that's the end of the move for years. So it actually works. It's worked very, very well.
And going along those lines, net, if you could bring up Net and Cloudflare, I'd be curious to hear your take on this one, because this is showing a little bit of a change in slope and an accelerated move on volume. So yeah, what are your thoughts on this chart?
Yeah, this is to me, it's extremely extended, and you have to always go back and look and see where the stock has been.
Mm-hmm.
And I mean, you look at this, and even before, well, I guess, even before it went through somewhat of a correction for the first 6 months of this year, the stock has already gone from, it went from 20 to 80. Okay, built a new base, and now it's gone from 80 to 189. So it's gone a long way, and now it's getting, I've always said, okay, look at the angle of assault, the angle of the move, and it's going like that, and now it's going like this.
Mm-hmm.
And to me, that's probably telling you that it's probably getting closer to the end of the move, and not the beginning of the move, because of how far it's already gone.
Yeah.
If this was happening, back here, and it almost looks like it happened back here.
Yeah.
I mean, look at this period from this spot to, I don't know, this spot. You really had 1 day down, 2 days down, and it looks like about 12 or 13 days up. So, so again, but if you get that, and you had a move like this, it's telling me the odds are in your favor that it's probably getting close to the end of the move, and you got to be careful. If you own it, then I would probably be looking for a reversal, and just piecing a little bit out every day.
Gotcha. And not necessarily with this stock, but a stock that you own that goes through a base and then kind of fails a breakout or breaks key moving averages. What would cause you to basically sell a position that you have, if that makes sense?
Well, if it comes back, if it's a stock that I had just bought, if it breaks out and then pulls back, then it would be the stock coming back down into the base and also coming back. I mean, like this one, I know I owned this during this period, and then I think I sold it on this break, and I never bought it back. I mean, this is just crazy. It's very, very rarely do you see a stock that breaks down that quickly and then comes back so much. Yeah. But that's, to me, again, it's sort of the times we are in with so much liquidity. Some of these things are doing things that are just very, very unexpected.
But basically, if you do have a position, it's trending nicely above the moving averages, and then starts breaking the 50-day, 10-week on volume, is that kind of your indication that the trend might be changing? Yeah.
Yeah. And you're always looking for change. You're looking for, what's happening in the supply demand ratios of the stock. And this, right now, yes, this is very, very strong, but just even, I guess, last week, it got some huge volume on the downside, which is almost, I think it's about as big as all the volume on the upside. But today, with the market being fairly strong, this one kept on going out. But so you're looking for a change in characteristic, and right now, yes, that's a change because it's now going up almost vertically, and I've always said that's like the air shows that you'd see. You go to the airport and the plane's flying along the runway, and then it starts going up a little bit faster, and then a little bit faster, and then it starts doing this, and at some point, it's going to start stalling.
Right.
And it's, if you can, it's great to have one of those, but you still have to treat it the right way and sell some of it out when it's going through that, because eventually it's going to stop.
Makes sense. And you had UPSC on here earlier, but I'd love to hear your thoughts maybe on some other growth leaders like AFRM, which doesn't have the earnings, but the price action is super strong. And just kind of go through the true market leaders in the growth space that you think, basically what you think the true market leaders are at this moment.
Well, I mean, Upstart, look, that's 150 to 400 in like 3 months or 2 months or so. I guess if your time frame is shorter, you can look for pullbacks to a little prior base or back to very close to the 21-day moving average. But you always keep on looking at that volume, and we haven't gotten any bad volume on the downside. But today it was up, but the volume wasn't as heavy as some of the down days. So you got to be careful on buying pullbacks. Is it AFRM?
Affirm, yeah.
Yeah, Affirm. You can see extended, and it looks like today it stalled.
Mm-hmm.
But it's just, when I see a stock that goes from 70 to 160, I just, I don't own it. I wish I did, but I just wait until a whole new base is built. I don't spend a whole lot of time. And if I owned it, so far it really doesn't look like it's done anything wrong. So you just stay with it. But to buy it, right here, you take too much risk.
Gotcha. Yeah, and maybe one more COIN, Coinbase, which is a recent IPO. The entire kind of crypto theme is also kind of working at this moment, which I don't know if that's something you're interested in or looking at.
Yeah, well, this is this is again straight up from 250, 325. I've been in, and this is only because of instructions from my son Sean.
Yeah.
This guy, he picked it perfectly back here. We were getting in down here, and we rode this thing up into that area. And then when it started turning again back in here, he said, let's get back on this thing. And we've had a nice little run, not as big of a position as before. But that's the only, he's the one who has told me we should be buying this stock. So I just think this is where I maybe I'm getting old, but I just think there's just so much speculation going on that sooner or later, there's going to be a time where it's going to, and I only felt this once before. This was during the 2000 period where there were internet stocks that would correct 50%.
Yeah.
Turn around and double and triple from there. And my rule was, if a stock dropped more than 50%, I wouldn't even look at it anymore, because it'd have to double to get back to the old highs. But you're seeing things that are happening. I mean, the same thing in Bitcoin. It's already doubled from the low.
Mm-hmm.
And this goes on. It can go on for a while, but at some point, and I heard this so many times in 2000, 2001, where people said, I made so much money in the internet stocks. and then I didn't sell, and I lost it all back. You have to have a sell discipline. If you're operating in the market and you're just buying based on what everybody's talking about, or just a chart that's going straight up, you have to have a sell discipline. You have to have, how do you get out? And it's always, how do you get out in? How do you get out? You have to have both sides, because some of these things are going to correct, and they're going to correct dramatically. And if you don't have sell rules, you're going to lose a lot of money. And this is a period which I've only seen a few different times, and they don't last that long, but you try to take as much advantage as you can while it's happening.
Absolutely. Are there any other concepts you wanted to cover when it comes to charting? Or I always like to wrap it up with one last question, but if there's something else you'd like to mention, or you think it's important for people to realize about how to interpret charts, go for it.
I think the way you interpret charts is you just study the great winners. I look at them week by week, day by day. I look at their moves. I look at their volume. I look at their price patterns. And I get that. I get the way you're going to do better is you're going to get what a move looks like. If you can get that ingrained in your head, I mean, even on, let me go back. You can just take this one stock, Generac, and you study it on the breakout and on the move and on the continued move, and you look at the correction, and you look at all the ways that the stock has moved during this period. You're going to develop you're going to start realizing what the characteristics look like of a great performing stock. And you got to get that memorized in your mind, so when you see it show up again, you'll be able to act upon it. That's the best way to do that. You can read all the books you can, and I have a little bit problem with books that have been written since O'Neill's book, because a lot of the books that have come out, some of them, they add a little bit to our knowledge base, but so much of the literature out there and the stuff on the internet is just regurgitating the same things that Bill put down 20 years, 30 years ago. And they change the concepts, they don't change the concepts, they just change the names. And they're just putting new names on things that have already existed and that have already been pointed out. But I guess that sells book. But I just have a problem with people keep on coming, repeating the same things that are out there. Again, there's nothing new under the sun. A great winner is going to act the same way it did decades ago as it is now.
Absolutely. And even going back to Jesse a little bit more with the pivotal points, the same patterns repeat over and over again, 100%.
Yeah.
Well, David, thank you so much for your time. I always like to end it with one last question. What kind of general advice would you have for a trader who's just getting started, or maybe has been doing this for 2-3 years, but is struggling to stick with the system, find something that works, and become consistently profitable?
Yeah, first, go slower. I mean, don't use all your money. Use a portion of your money until you can start making progress in the market. That would be one thing. The second thing is, study the great winners, and get those characteristics, down in your mind of what to look for, and just study those. Spend hours. I've spent hundreds and hundreds of hours studying these great winning stocks, and then read Bill's book and read that over again. There are not that many classics that you should be reading, and then just have a very humble attitude. Be willing to examine yourself, your mistakes, and see where you're going wrong and correct those mistakes, because that's where you're going to learn as much as you will from reading every investment book out there.
And outside of Bill's book, How to Make Money in Stocks, of course, which everybody should read, what are a few titles that you think are definitely worth it for new traders to pick up and take a look at?
I think Darvis's book, How I Made $2 Million in the Stock Market, that's a classic. You can read that in a night. That's a great book. I have Mark Minervini. He's got a couple books out. I think those are good. And he kind of expands on some things, and I think some of his best parts are on risk management.